welcome to today's Morning Market on Close. My name's Will from The Officials, and I'll be taking you through today's Singapore window. I mean, in broader markets, the mood has really turned. We've seen across equities and crypto, it's all in the red, and markets are starting to feel a bit risk off again. But what's been happening in crude? Well, after Monday's sell-off, we can see Brent has started to kind of consolidate a little bit, finding a floor around the kind of $64 a barrel range. We've kind of just been oscillating between 64, 64.50, kind of trying to find direction. But really, it's all about what's going on with sanctions. Are sanctions going to drive a rotation in Indian feedstock away from Russia? Well, according to a number of refining sources, yes. But if we look at pricing, I mean, that really doesn't look to be the case. If we look at Dubai spreads, for example, on this second chart here, they're really softening. I mean, and this has been something traders have been watching really closely. We would have, of course, expect a bullish move in spreads if India was forced elsewhere. They'd probably choose Persian Gulf with freight where it is right now, and the relative cheapness of Dubai. But we've seen the time spread crush down this month, and yeah, we're lacking any sort of bullish impulse there. But also looking more deeply at the players, traders are reporting a massive sell-side presence from the Chinese. That's both in the window and in OTC markets. I mean, would you be sell-side if you had a massive obligation to lift for SPR inventory builds? Of course, no one other than the CCP themselves truly know the intentions with the SPR, but China's rotation is stark. If we look at today's window, it followed a similar trend as yesterday. If we pull up the physical premium chart, we'll go here. We can see, again, we've had a continuation down in the physical premium. We're now down to 132. With partials assessed at 65.60. Totsa was still driving the buy side, while Sinochem and Unipec, among others, were back selling. We're still waiting for our first convergence, but it looks like we'll be getting that tomorrow. Thanks a lot for watching, and tune in for the afternoon window this afternoon.
thanks so much for being here and making the move into the actual office. This is the first proper interview from a third party. So
fabulous. Yeah, very, very impressive, I have to say.
Thank you. Well, look, the first thing for me straight away, loved your book, genuinely, not just saying that because, you know, I've got you on the show.
I loved your book too, by the way.
Oh, thank you.
No, I really, I'm not just saying either.
Well, look, the reason why I want to justify it is because when you look for a history in the market, you can go for the world for sale, which is quite a good overview, oil 101. But I think the hardest thing for an entrant is, you know, what's really going on? It's a bit like an employee coming into a company and saying, okay, I've been given the corporate spiel and I know kind of what we're doing. How does it really work here? You're only going to get that from this book. And you learn the history of, and you can even feel, and certainly, I guess, because I know the market relatively well in the last 10, 15 years, you can kind of feel the tensions, the how people are thinking by the stories, which is like such a great thing to have done. Yeah. And it may seem very niche, but you know, it is a niche market, but that's, if you're in this market, you should want to know the niche stuff. So first of all, honestly, that was great. But I guess that would be the first question for me then, which is like, having explored all these stories again that you obviously knew, but you're going interview sure. and all that kind of stuff. How did you summarize it with Addy about how you kind of see the oil trader mind? You kind of alluded to it a bit about the entrepreneurial mind and this kind of stuff. How would you summarize it now?
Yeah. So Addy and I spent the best part of a year and a half researching. It's a little bit like wallpapering the front room of your house. You know, 90% of the work is in the preparation, and then having done the year and a half of research, you know, he wrote some chapters, I wrote some chapters, and we did it in the space of 4 or 5 weeks, and you know, produced what we've produced, and we were trying to put something together that was different to anything else that was out there, and something which memorialized a business which is huge. I mean, it's the, you know, the largest, least well-known, most remunerative business probably anywhere, and
most niche but most impactful, I would say.
Yeah, the most impactful is a good description, and we wanted to memorialize that because it hadn't been done. You know, Javier Blatter, a wonderful book, and with Jack Farchi on the World for Sale. You know, Deeds of Daring Do, you know, very much for the general public. You wrote a wonderful, very clearly put together book on derivatives. Liz Bosley's written some books on the physical markets and how they operate, but no one had written this sort of, you know, memorialization of how the business started, who were the people that put it together, where were the places that it happened, and how did this social construct come to be and come to create this massive market we now have. And so in doing that, of course, you analyze very carefully the people who were involved. And what we didn't want to do was to lionize people who had used the market, you know, and benefited hugely from the market, and perhaps have been lionized elsewhere as wonderful traders, which they probably were, but who didn't really add anything to the way the market developed. So, you know, someone like, maybe I'm being unkind, but someone like Andy Hall, for example, lionized as a fabulous trader.
King of oil.
Was a fabulous trader, you know, on a Tuesday night in, you know, the 1980s when the API stats came out and you were long or short a cargo you didn't want, you had to call Andy Hall because he was the guy that would take it off your hands. And he was a wonderful trader, but he didn't really, in my mind anyway, add anything to the way the market,
the infrastructure and
developed. Mark Rich did, on the other hand, created something. So you get people in the book who we think have added something. Jeffrey Sprecher, clearly somebody who, in the way he developed ICE, created something.
If you don't mind me saying, the one person who maybe got shortchanged was Jorge.
Well, actually, that's very interesting. So you on your board have two of the people who I would most admire in the industry. So Jorge was massively influential in the way that the markets developed and the products developed. You know, he came in with a sort of muscularness, really, and did things that other people would not have done, and things that needed to be done and were accepted. The other guy on your board who I, you know, hugely respect is Peter Smith. Peter Smith to me is the ideal trader. You know, low risk, regular revenue, great mentor, great leader, nice guy, and you know, These are
Trading as a business.
trade is business. So anyway, back to your question after a bit, bit of rambling. What do you need to be a success in this business? Well, I think it's changed somewhat in some ways, but in my mind, the person who is successful needs to be humble, because if you think you're bigger than the market and you know more than the market, you will fail. So you need to have a humility relative to the market. I think no question whether you're a technologically focused or a merchanting focused person, you need to have a mental arithmetical ability. You need to be good and quick with numbers. I think you need to be dispassionate, cool, able to put bad trades behind you and move on. That's very important. And I think you need to be able to really understand your competitive advantage. I think a lot of people don't really understand or seek to understand their competitive advantage, and they end up going down the wrong road, or not focusing on what they are really good at. And then of course trading, I think in the interim, this 50 years has gone from being a single person activity to being a team game. And as with all the folks you've got, you can't just have one man who's at the market interface being the trader. You have to have the salesman, you have to have the analyst, you have to have the structure, you have to have the whole kind of ecosystem, which is now behind trading. And so trading is a team game now, and that's a big difference.
I think the way you were describing that is so interesting, because going back a bit, you were saying that people who've actually innovated and changed the market, I would go as far as to say that is what you need to be in this business, because I don't know if any other asset class has the same dynamic going on, which is constant reinvention. So I mean, I can think of a million examples, to be honest with you, but even as a North Sea trader, paper trader, but watching the North Sea physical traders, for a couple of years' time, it will be a major who's the completely driving force behind the market because they have a particular asset that's particularly useful or a particular relationship. So Huandong, you talked about, and Shell, he was the first one to form a relationship in China to take 40s, and that changed the way the whole game worked for 2-3 years. And then it got reinvented again. Remember the South Korean arbitrage. You've had now TOTSA with the Midland, they're advantageous. And you're constantly having to figure out, where am I? Where is my competitive advantage? And what is going on in the underlying dynamics of the market to allow me to capitalize? So someone like a paper trader, our advantage way back in the day with Mandara was just looking at the mechanism of how the curve price, as simple as that. But you focus on where you can have advantage and what the market's doing, and you end up, monetizing it and deploying your strategies. But in turn, the market evolves.
Oh, you have to be on the ball, because it's a complex matrix, isn't it, of geography, of products, of product quality, of the temporal aspect.
But what I'm saying is the ultimate capitalism at play, because then you're making money doing these strategies. The market then evolves, and the ecosystem gets more complex and sophisticated, and then you're on to the next one. So every trader has had to do that. They've had to be a business builder, even though they're a trader.
And I think you're right to point out there are certainly few markets, I would suggest, other than this market, that actually have gone through and are going through that process. Maybe the credit markets would be similar, but I don't think foreign exchanges. I don't think equities is really. I don't think metals typically is. This is very much unique to the business that that we're in, and to oil in particular.
And I think that goes a way to explain why those markets have been so much quicker to systematize and be so algorithmically driven, whereas oil, of course, is, in Brent and WTI, but it's got a long way to catch up in other markets because of this complexity. I think that answers that.
Yes, I think that there's a degree of complexity there, perhaps, that, again, other than the credit markets with the sort of layers of debt and concepts that they have in that market. There's more in oil than in any of the others for sure. One development, though, that I will not be popular in mentioning it, that I think has added nothing to the course of events, is the introduction and development of speed in markets. I don't see any social or economic usefulness whatsoever
Of speed of the execution, or
speed of
Okay.
execution. And it's the same thing applies in the equity markets and other parts of the financial services world. Speed is self-serving in my view, and there are many companies out there and individuals who are making huge amounts of money through the application of technology and speed to dealing. But I just don't see that maybe in a minority of one, I don't know, but I don't see that adds anything whatsoever to social or economic benefit. And
I've not heard that before, but I can see your logic. I mean, and that's why I guess it's quite orderly still in some markets, like again the North Sea market, where they congregate around the 4 to 4:30 window, and everything's kind of pre-prepared for that time. It is still quite slow. I mean, they do catch waves of, oh, the Brent's moving, so I need to do something. But I guess, yeah, it's still to some
someone from XTX will probably come and try and shoot me for saying that. I don't know, but it's one of my little hobby horses. And
interesting.
if I was a regulator with a magic wand, I would take away speed from markets.
And how would you do that, do you think?
I have no idea. I think it's virtually impossible. The vested interests are such that it
Well, you'd shorten the windows where you can trade.
I would find some way of outlawing technology that allows algorithmic trading to happen in a microsecond. For the benefit of the algo trader and no particular good economic or socially useful reason.
Well, I guess that sets up quite nicely. There's the future we've got to talk about, but obviously learning from the past to predict to some extent the future. And the bit I have to talk about because it's so particularly interesting to me is the switch from the banks kind of running the derivatives game with their bilateral trading to the exchange.
Yeah.
And you credit Jeff Sprecher being a huge part of the whole market because of what he developed. But again, the reason why I mentioned Jorge at that point is because maybe I'm wrong here, or maybe I don't know, but it seemed to me that it all came together at once. And I think Jeff in particular played the cards right. For example, okay, we need Platts numbers need to be aggregated in a more succinct way with timestamps. Okay, that needs to be done with technology. Someone needs to take the lead on that. And by Platts aligning with ICE, that was a huge moment on retrospect it sets the governance today. I mean, ICE's integration with Platts, the e-window, the data, it's so intertwined and so entrenched. We are where we are today. And I guess that's why I said the Jorge bit. But having said that, yeah.
You're absolutely right. The Platts have been criticised over the years for very many different things, and ICE too. But what they've managed to do together is systemize something in a very complex market.
Yeah.
Which required to be systemized, and in a certain way they've assisted in the democratization of the market and enabling people to operate in the market with confidence. And I know you're very keen as an individual and as a company on democratizing access to the market, and they played a big part, both of them.
The problem now is what you'd expect with any kind of capitalist venture. They've done their job very, very well, and they got remunerated and rewarded. Now the entrenchment is so deep. We are where we are, where we see Platts increases 300%, increase on fees year on year. Everyone's complaining about that. ICE have that very strong hold, and it's now getting into legal and regulatory realms, which I personally don't see how it's sustainable, because we've solved the problem, which was visibility, transparency, getting that big boom in volumes, and the ecosystem becoming more sophisticated. But now I think it's that threat of we're not able to continue to achieve the things that you highlight so well in your book. If we go back, Morgan Stanley seemed to be in particular very important to some of the birth of some of these new contracts and how to trade, and we could talk a bit about that. But I just wonder if you had any thoughts on why were you so freely able to innovate without restriction? Were people kind of on your side when you had new ideas?
Yeah, that's a very interesting aspect to think about. And there's a story going back to the beginning of Morgan Stanley when Nancy Kropp had come from Sun and John Shapiro from Conoco, brought into Morgan Stanley to start up their business, and they were then asked to take on a very, very bright 27-year-old from within the bank, a guy called Mark Crandall. Mark, of course, subsequently went on and founded Trafigura and had a wonderful career and is a wonderful guy. And Nancy had to explain to Mark, how the rent market worked. So she explained how the rent market worked. And Mark listened, and then he thought a little bit about it, and he said, right, Nancy, now we're going to change that. And in fact, Nancy just retold the story to me a few days ago when I saw her. And that was what he wanted to do, and he was able to do it, and the market was receptive, and Morgan Stanley did it in a similar way that you do it with Onyx, as a client-centric activity first, proprietary second, and there were no barriers to doing that. Regulation was light, to say the least, and internal permissibility, capital use, all that kind of stuff was a thing of the future. Nobody cared about it at that point. So it was easy. Yeah,
but you see what I'm getting at here? So you've got a genius comes along, got this thinker, or these geniuses all thinking about how to make their market work better. And then you get into the second part, which is how do you execute this in an orderly function? And you hand over to third parties the operational running. Those third parties, you create a monster.
Yes, no doubt about it. And that monster is out there, and you're right to recognise that. And how do you change that? How do you further democratise?
Well, that's what I wanted to bring up.
It's harder for you. Maybe the regulatory environment is a little less severe than it was 5, 10, 15 years ago. I think it's probably lighter touch.
Well, I was going to bring you back to the Enron Online part, because in this context, because it was really fascinating. I heard different stories about Enron Online, and the way you portrayed it was, this was immediately seen as a threat. So just to give the context, Enron, everyone remembers Enron as obviously this big dodgy enterprise because of the accounting side, but putting that aside, an incredibly innovative trading business,
absolutely, yeah.
Top talent and all the rest of it. So what their idea was to say, we will be a single dealer type platform, or we will be we'll offer you the liquidity on a screen. This is going back to like 1995 or something like that. Or
99. Yep.
And so a long time ago, this is what we're going to do. And it did launch, right? It did work for a little bit.
Yeah. So it was really championed by a very smart lady who called Louise Kitchen, who subsequently did some other things within the commodities business. Very, very smart person. And she championed this concept of an exchange where the whole world would come to Enron. So it was one to the world rather than, everybody to everybody. And so we kind of thought that really wasn't going to be very good for Morgan Stanley, Goldman Sachs, Shell, BP, and the people who were providing the value in the market. Yeah. Liquidity, because liquidity that's the value. So we got together, and the book describes how we got together. And I know it to be true because I was there.
That's what I love. That
as Max Boyce used to say, I know. But
you're able to get together. That's again emphasizing. Well, you couldn't do that now. People are so worried about collusion and things like that.
Yeah, we did it. It was interesting. There are a lot more little sub stories to be told on that. But basically, Dick Bronx, who was my equivalent at Goldman, GR, and I went out and we persuaded all these people to come and join us. And then, having done that, by complete chance, Jeffrey Sprecher turned up at Morgan Stanley's offices with this technology platform.
Oh, it was genuinely concurrent.
Oh, genuinely concurrent. So he turned up with he cold called, came in, and he saw Neil Shear, who was the boss of commodities at the time. And I always remember Neil coming out of his office and saying, I give that platform a 5 out of 10, but this guy Sprecher, he's a 9 out of 10 at the very least.
Wow.
And that then led to, the combination of the platform, the European oil.
But I'm fascinated, and again, this is the social side, how you're able to convince each other, or one person's able to convince a group, we're not a threat, or we are a threat, or whatever it is. And when I spoke to Dick, actually, this was in the first year of Onyx. We were thinking of making our chairman. Anyway, he was. I was very curious about all this and the Goldman Sachs index, and he said basically the main pitch from his point of view was the pit trading that's going on, and the locals, which I guess we're the locals now, the market makers, or Stanley became them. Them on the floor. He said, you're losing so much money a year to them. If it's on the screen, they won't be able to be doing this kind of that. He said that was his major push.
I think we maybe had slightly different objectives, but they weren't mutually exclusive. I think the objective that we had in Morgan Stanley was that, and we had to persuade a number of our senior traders that this was the case. But the objective we had was to increase volume, because we believed that if we increased volume through transparency, we were in a position to be able to do much more than anybody else could with that volume, and would have more opportunity. Now we would cannibalize some of our more opaque over-the-counter businesses doing that, so we had to give something up. But it was
incredibly progressive moves like that. That was like, it's a very impressive thing to have happened. I don't feel that that's possible anymore. I don't know why I say that. Maybe we can explore in a bit. But
you don't have the community, I think, that we had. So the thesis of this book we've written is that it's a social construct, and it's people and it's place, and we all knew each other, and we all kind of got together in different settings at different times, and certainly we competed. There was no element of collusion whatsoever in anything at all. But, people were decent, and people were friendly, and people were, intelligent enough to understand that working together was possible. I think now the objectives of different companies, the size of different companies in different sectors, different focus, different cultures is so disaggregated and so differentiated that it's going to be very hard to replicate what we did.
Yeah, it's a bit like people complain about the EU. You got this big bureaucratic thing. It's so hard to change things, and it's protectionism. I personally see it being more of a newer entrant, I guess, in this story. To that, I'm shocked at how protectionist everyone is. And I mean, this is not even putting the singular blame on anyone. This is every single trading business. This is the brokerage community. This is the exchange community, the PRAs. They like what they've got. They don't want to let it go. But someone, like Morgan Stanley say, yeah, we're going to have to give up a bit of this, but we know where the world's going. Let's position ourselves well. I don't see that. And I think it's so obvious that we need a next new evolution, but we are a little bit stuck in this mode. Anyway, you answered it fantastically well. It's the community we lack. And, I've been told myself, it's like, Greg, if you want to do things, you need to make friends. You can't have an enemy with everyone. But I'm like, look, to be honest with you, I was locked out of this market for 2 years. People wouldn't even show me numbers. I had to fight my way in. So I don't see the community the other way. Like if there's a coming together of minds to be had to create something that works for the benefit of the trading community, I am 100% for it. Yeah. But I don't know why there's such a resistance to it, I guess.
Yeah, well, probably or possibly it's because, whereas in my day it was very much a social construct, and in your day now there's quite an element of it being a technological construct, and there's an anonymity that comes, I think, with a
fear, I guess.
A fear and a distance.
Yeah.
That the contiguities of place as part of the social structure.
Colin, where I do massively agree with you, and I think it still exists, is liquidity is the value, and it's not that many players. We're still in a market that's disproportionately influenced by a small number of individuals. You could get the 10 biggest traders in derivatives, let's say, together, and you would still be 80% of the trade. I mean, I know there's algorithms and all that kind of stuff, but it's still hugely influential.
The difference, I think, now from my day was that large element of that liquidity was offered with client centricity behind it. It was helping people understand how to manage their risk at the market interface and providing the liquidity for them to do that. So you were certainly proprietary trading, basis what you were doing with clients, but proprietary trading, certainly in Morgan Stanley, was always secondary to serving the clients. Now, I don't see there are so many folks around who are providing that liquidity today who are doing it to serve clients. I think that element went when the banks were exited from the market by the Federal Reserve in the US, and you guys have come in and you're trying to do that, but there are not too many others, right? Most of the others I see are, they're Andy Halls. They're looking to, make their money. Fine, that's The
market's so developed and sophisticated that you still get a year like 2022 where the need for oil traders is so high in the world. the ecosystem to do it is so well positioned and so high functioning. A lot of money is to be made by staying true to the system and delivering the economic function that is required.
That's the merchanting side.
But I think it all came together, like the derivatives and everything.
Came together.
It's a great example of that's how a mature market keeps something in line. I mean, was it nickel couldn't handle volatility? Oil handled an incredible amount of volatility. Well, I think.
Yeah, I think, and the structures that Jorge and Jeff Sprecher and all of us in our own little small corners have put together over time, developed in a way that the market, became robust and was able to cope with all of these, changes and issues that arose in the market. Coped very well. Some people were very well rewarded for that, so they should be, because they enabled things to happen that made stuff cheaper for people.
Yeah. And back to the Enron Online thing, I just wanted to finish that. So they all came on this one for everyone solution, and then you guys thought, we should benefit from that. We don't like that. It should be a community-based thing, I guess. And then it was the idea to set up a business together. But you were kind of leaning, so it was Jeff's business and he was saying come a part of it, or you kind of all came together at one, or?
So the business belonged to the equity holders, and Vic and I went out and we offered equity to BP and Shell and Total, etc., in return for guarantees of liquidity. So, they got 12, 13%, let's say, which when they finally sold it, they all made $1.5 billion.
Yeah.
So they were the owners, and it was a collection of 5 or 6 or 7 people. And
so how was it sold? Was it IPO?
Jeff was given equity, obviously, as well at the time.
Yeah, but he just IPO'd it, and that's what got
it was and it went in periods of different offerings, and the objective of the owners and the folks who had set it up was to get out of it as soon as we could, because we didn't want it to be our system. We wanted it to be the market's platform, and there were those who were unhappy at not being included. So Vitol, for example. But Vitol in 1999 were nothing like the force they are now.
Look, it's funny you say that, because when I spoke to a Vitol trader about this, he was saying, well, his version of the story was, we didn't like the idea of it going to the screen because we thought we had an advantage on the pit. Do you think that played a part in it as well? Or?
Maybe at some levels within Vitol, but I think Ian Taylor, who was running the business at the time, I know he wanted in, and we didn't let him in.
Oh wow! Okay.
So Steve Semitz and Steve Hendel were the same. I can't remember. I think they were called Hepco at the time.
Right.
They wanted him. We didn't let them in.
So, because I've had this conversation over the years recently, is that why are we not doing this again? Why you've got T+2 settlement, you've got a lot of inefficiencies. I know you say you're not a fan of speed, but you surely are not a fan of inefficiencies and clunky capital and high margining and things like that. Things can be done a lot more efficient. There is another next boom to be done, because the technology has been around for a long time. It's just about oil catching up. So why doesn't, if Vitol missed it the first time, come and do it the second time, and all the other companies. And it was interesting because one company said, well, you do know that since 2022, it's actually very awkward to be part of market infrastructure because so much money was made. You want arm's distance. Well, that's the pricing mechanism and whatever else. If you're seen to be part of that, that's actually a bit of people don't want that anymore, whereas they clearly weren't afraid of it.
Well, we thought they might become afraid of it, and that's why we wanted to, hand the thing off as quickly as we could. And I can understand that, there's always going to be that suspicion. It was the same when, in a different context, when we were talking about how to extend Brent, whether to go to, Midland WTI, whether to go to Johan Sverdrup. And one of the reasons that was cited strongly, actually, against using Johan Sverdrup was that it was very dominated by Statoil, and that domination was something that made people suspicious. And it's the same sort of sentiment, isn't it? That you have to have this sense that people trust and feel that the platforms and the venues that they use are independent and reliable.
But seem okay to give up the pricing element of that in terms of fees. We'll pay the high fees, fine, but as long as there's that distance and no one else has a competitive advantage. That's clearly the pain point.
Level, it's the level playing field concept, really. So, but I am, I kind of sympathise with you, Greg, really, because I see you trying to do things that clearly would, in my mind anyway, be beneficial to the way in which the market structure was and could develop. And yet it's so difficult. There are so many very, very deeply entrenched interests being hugely rewarded, perhaps in a way that wasn't the case in 1999.
Yeah.
That protectionism, becomes the first thought.
And I do think they've kind of forgotten who put them there and how that works. And that's maybe a separate point. To move on, I would say the very interesting dynamic as well is that, clearly this, and you do mention it quite a few times, this link with Wall Street refiners, Wall Street paper players, and the innovations. It's just the way the beginnings of the banking system as well, right? All kind of made sense. Do you see a similar thing with the emergence of the East? People have been talking about the East growing for a long time, but I see now they're genuinely getting very into paper trading. In China, for example, the exchange volumes are incredible there. India's all these stories about stock options. And, I'm personally seeing that is the area that, if you really think about and you really read your book, you get this sense of very Western. It's a Western operation, but it's growing. Do you agree with me? Do you think it's going that way, more East? And
it certainly seems to be. The center of gravity, I think, moved in the 1970s, early 80s from the US to the UK, Europe, and it's been stuck there for quite some time. And I think you're right. I think the center of gravity is, picking itself up and thinking about moving east. There's a lot happening in China. India has a colossal future in many respects. We're seeing the Middle East become a legitimate trading center, and people and ideas are collecting in that area. So yeah, I think in all probability there's opportunity there that there wasn't. China was always a domestic opportunity in the course of the last 50 years, more than an international opportunity.
Well, this is what I was going to say. To flip it on its head a bit, what I just said. Can you really beat the free market thinking of the Scottish in the North Sea, and then everything becomes, and then London this hub, and then the same with the US and obviously their innovations, technology, etc. There's this freedom to explore and innovate that I find I don't really get. I've seen these explorations of let's build an exchange in the Middle East, let's do China's got their exchange, but there's capital controls, and India have capital controls, and it's not if they embraced what we did, let's say in Europe and US, they would have already had.
Well, it's always been very disappointing, and for many years, the consumer of oil or power didn't have any risk really, because there was a pass-through concept from companies to individuals and etc. And so there was no risk to be managed there, and so there was no need really for markets to let people hedge in the market interface. And to an extent, I suppose, you look at China, you look at India, that they are sort of managed places, aren't they? Managed economies. They're not really places that have the same depth and history of free market thought that we had. Russia was a prime example. I mean, I did a lot in Russia in the early 1990s, as did a lot of my contemporaries, and
because they wanted to have an exchange.
Well, they've wanted lots of different things like that over the years. So they said, and but here we are 30 plus years later, and you still can't really trade anything. It's it's been disappointing from an open market trading perspective. So, but I do see movement in that direction, and I think the development of Dubai as a trading center, albeit there's an element of sort of Russian sanctions action there, albeit that's there. Nonetheless, I think there's a sense now that markets are starting to move east a little bit.
But even to make it to current day, I mean, oil on water from Iran has been a thing for 10 years, but now it's Russia, and now there's so much sanctioned oil, and there's two-tiered markets with China and India and Russia, and I thought it would be temporary. The market was pricing it like these things are shocks. It kind of looks like it's materially shifting towards this possibly de-dollarization that's been threatened for so many years, but at least a restructuring or reimagining. And I think that's oil traders always have to keep up with that. I mean, I don't know, but it seems like this year was possibly the most. Usually we like volatility, but to get the Trump style, tariff style, import export style volatility has been carnage, and sanctions, because now you're having to juggle what the physical market is doing versus what the benchmark oil is doing versus, like, it's all these things going on. And then the FOB contracts versus CIF contracts, it's causing mayhem because it's, you know, for example, the propane contracts, you would think US into Asia constantly being sent that way. How does that differential not go down an incredible amount once the US are no longer sending propane there? Well, there was a nuance in the FEI contract, which meant it did the opposite. And you're like, that kind of stuff.
That's opportunity, and that's the sort of opportunity, you know, over the years that people have managed to monetize. And if you can monetize an opportunity by mining someone else's indifference, you know, taking value out of something that your counterpart doesn't care about, then that's always the best way. And sometimes, you know, mining the indifference of the piece of paper that has this particular regulation in it is the way that happens. But
I think that's what makes it so difficult for you. Mentioned XTX, the Jane Street. This stuff will drive you crazy because there's no system for it. It can change. You introduce WTI Midland, that changes everything to do with the crude contracts. There's no historical things to analyze.
So you mentioned XTX and Jane Street. You know, that leads on, I suppose, to another thing, which is the element of size. You know, it's such an important aspect these days, having size and deep pockets and being able to wait until the market does what you've you know, put your positions on to think it's going to do.
I think natural gas has proven that to a big extent, but I think oil still struggles. I think you still hear stories of these big funds struggling to make consistent profits without the physical information. I still think that's an oil unique thing.
That is very true. I completely agree with that. And I think, you know, that's something that won't be solved by AI. That's, you know, that's where you're looking at the, you know, significance of a shrug of a shoulder or the way someone kind of intones and things that, you know, you need to find out by being there, knowing that person, you know, face to face.
But the integration of the oil markets into politics, I mean, it's always been a thing, but now you kind of get the sense that there's a lot more active players that have government type information and they're utilizing it. That certainly seems like a new thing for me. But just maybe the final thing to discuss, for yourself being where you are, and particularly, I mean, I found when I wrote my book that it's such a great exercise for self-development because you know this stuff, of course, but by going back and making it very clear and concise and creating a narrative, it really empowers you. Empowerment of thought. So given that situation you've now got, I mean, you're not that old, right? You've still got a lot to give in the market. You know, it's not like you have to stop anytime soon. So what would you like to see, given what we've just discussed and given all the challenges going forward? Would you like to see a retrenchment in a way of a community, get back to the community sense, or do you think it's unrealistic, or, you know, what would you like to see?
Well, I don't think we can go back. I mean, I think we can look back and we can say, look, what lessons can we learn? And, you know, lessons from history are very valuable, as we all know. What can we learn from, you know, this last 50 years? But I don't think we can go back to it. That doesn't really ever seem to me to be a good idea. I think we have to take what we know from there and apply it looking forward. You know, I've told you I would like to see speed eliminated, but that's not going to happen. But I wish it could. You know, I just hope that the social and face-to-face and collegial and you know, contiguities associated with place that have served the market development so well can continue in an age where technology is looking to beat everybody. And, you know, I think that's a challenge because technology is easy. You know, people develop the stuff, you sit at the desk, you've got your computer, you don't have to worry about traveling up to the West End for lunch or going over to Los Angeles to meet a client. You know, I just hope that people won't take the easy option and that they will retain the social structure element.
But it's something you're still doing. It's something you're still interacting with people.
Yeah,
and
absolutely.
I think you've got a big part to play in that. You know, even after this book, it's like a reminder, you know, these things, as much as we love technology and AI, it's not going to solve some of the intricacies. Maybe we do need to be getting around the table a lot more. And maybe that's something you can be helping with.
Well, you know, AI is there to be used. And it's wonderful because it'll make people better traders because it'll give them more information and you know, the use of AI is wonderful, but you know, not I think to rely on it to be the thing that, you know, lazily develops markets. I also think what you're doing is very important. You know, trying to ensure that there is a client centricity, a liquidity provision, a democratization continuing, and that, you know, some of these vested interests and you know, behemoths that are behind the way in which the markets trade are not allowed to completely dominate and monopolize and are challenged. And you know, good on you for being somebody in a company who challenge that. It's
well, thank you for saying that. Honestly, thank you for writing the book, because someone needed to. You used the word lionize. It needs to get the reality of what it's like to be in this market, and that conceptualization that's so important. And that this book is what it takes to really be in this market. And you mentioned maths. I would slightly disagree, because I just think you've got AI now and things like that. You've got to have a conceptual brain and maybe an entrepreneurial brain. And I think you emphasize that fantastically well. And there's so much more history to be written. Thanks for everything, and thanks for coming in.
Yeah, no, Greg, thank you. And as I said at the start, I really enjoyed your book as well. And I think hopefully, you know, we've both added something to the canon.
Exactly, and many more to come.
Cheers, thank you.
Hello and welcome to the latest episode of the Hedging Show. I'm Tom Fawcett and I'm joined as usual by Harry Campion-Evans. No Julian this week. I think he's on holiday.
He's on holiday. He's having a well-earned week off.
Yep, taking advantage of his newfound celebrity status. This week we wanted to talk about marine fuel hedging and why credit is an important aspect of that industry, but why, certain participants don't always know the true cost of that credit.
Yeah, we thought we'd sort of try and lift the lid a little bit on the kind of, opaqueness of the credit industry and why it's so important in shipping anyway.
So I guess that's a good starting point. So why are these sort of shipping companies so reliant on credit?
So, as I understand it, in the shipping industry and like maritime industry in general, you have long payment cycles.
Yeah. You've
got a lot of operational costs which are paid up front, and generally it's quite a tight margin industry. You've got quite tight margins on sales of bunker fuel. It's very competitive, but I think more importantly, it's the payment cycles of the industry kind of lend itself to this kind of credit, methodology, I suppose, where you've got, transactions need to be smooth at different ports, like everything needs to keep moving. A lot of the cargoes that are being moved are paid for on delivery, whereas the fuel is being consumed on the journey. So you've got that kind of mismatch in, paying for something up front, but not collecting the revenue for what you're actually delivering until later.
Yeah, so I guess it's kind of similar to what we talked about before in the aviation industry, isn't it? Where you've got these like particularly low cost carriers operating on super tight margins, wanting to hedge out, a long way into the future.
Correct.
Because those margins are so tight, they need to be able to defend them, but they don't necessarily have the liquidity available to be able to fund those hedges.
Because as we kind of discovered, the airlines don't get paid until the flight's actually landed. So that ticket you think you've bought for a year ahead, they have to kind of lock in the fuel costs for that, but they don't actually receive the cash from the ticket sale until the flight's taken off or landed. And it's just like the payment cycle thing. It just doesn't kind of match up. So if these marine fuel suppliers and consumers are paying upfront or depositing collateral for a hedge of something that they're going to use in the future, none of that kind of cash that will be like a receivable they won't have any of that cash received. So there'll be a huge mismatch and they'll basically be operating as like a bank almost.
Yes. Yeah. So, and I guess it kind of brings us neatly on to why sort of banks have been quite dominant in that space, kind of, plugging that liquidity gap.
Yeah.
So they provide a lot of the hedging services, don't they? Even though they're not, natural liquidity providers in that space, they can leverage their balance sheets in order to provide the credit for these shipping companies to hedge against.
Yeah.
But they're not always, I'd say not always is a bit generous. I think they're very rarely transparent about the actual cost of that, are they? They're typically kind of showing an all-in price, which has got some kind of, markup
and it seems
baked into it.
Yeah, and that could be, well, again, we don't know always how transparent they're being with the customer, but, it's not just the kind of, there's obviously the bid ask they have to cover and the internal cost they have to cover, but there's also kind of credit risk. There's all these layers of like risk which they're trying to bake into one price. And like obviously as you keep adding these layers of cost that they're trying to bake in, you just keep getting more opaqueness. Which suits the provider because they can just keep justifying like a wider spread. But it also, and what we've kind of also learned recently is that it can give the illusion that services are being provided for free.
Yeah.
And then it's like, you just pay this one cost and everything's free. And it's like, well, how, because everything's not itemized, you're just saying, well, it's just a bid offer spread, but actually like it's not a bid offer spread. You're just kind of charging everything on the execution.
Exactly. And it's like all these things, nothing's for free. So it's like, if someone's offering you a, commission-free stockbroking, for example, they're making their money somewhere else.
So that was the thing with Robinhood, right? It was like commission free and everyone jumped on it, but then it just turned out it was like at the post office when you do your money, it's just, you just get a crap rate.
Yeah, exactly. You're being shafted somewhere else basically, aren't you?
Yeah, exactly. And no one's going to lend you money for free.
Yeah. And I guess where the banks have been able to kind of take advantage of this in the past is there just a lack of transparency in this industry. The companies hedging didn't necessarily know where value was. So if you showed them a price that was, broadly where they expected it to be, they don't know whether they're paying, like $1 a ton above value, or $5 a ton or $10 a ton above value. And that's why having access to something like the Flux platform is so valuable, isn't it?
Yeah, absolutely. I mean, it was not in their interest to give transparency, but it also, the fact that the business was going on for so, what is going on, just shows like how important cash is to these shipping companies. That, because like we said before, a lot, the banks have this kind of synergy where they're often providing like trade finance to the shipping companies. So it's all they haven't got these guys cash, or they've got collateral or whatever, and they're kind of happy to offer them credit to take on the derivatives trades.
Or they might even have some kind of like factoring arrangement or supply chain finance or something like that. And I guess the more kind of hooks they can get into
it reduces their overall risk. So they can kind of they can say like there's we've got a lot of credit risk, but actually it's kind of negated in other areas of the bank. But either way, it just shows like that concept of like dead cash and what it's worth to the shipping companies. Would you rather not know how much you're paying, or would you rather deposit money in an account for to receive like a transparent price, trading on the exchange or whatever, and
and we've had some conversations like that, haven't we, where we the people almost kind of know that they're being ripped off, but they almost kind of don't care because it's not like an explicit charge. They're like, okay, well, it's just it's all baked into the hedging cost. And I think Julian's been very clear on this point in the past as well about how important it is to show your hedging costs and your actual purchasing costs, put those on the same balance sheet so you can kind of offset the P&L from both of them. Don't just be like, okay, well, we lost X on our hedge, but we procured this fuel brilliantly at a much lower price. The two things should be netting off, and you've got to kind of look at everything holistically to understand these things.
But it seems like it's easier to swallow when it's just a bit off a spread that you're crossing, because there's no kind of like there's no sort of notion of like money being handed over. Whereas if you itemize costs and things are kind of charged separately, then all of a sudden there's an issue. Even though it is more transparent and you're getting a tighter price, people would almost rather just not know and pay their wider spread.
And I think there's quite a lot of research around this type of thing, isn't there, in terms of like trader psychology. And people would much rather take a kind of percentage chance on a larger possible future loss versus like a kind of guaranteed smaller loss now, even if the odds are against them. It's kind of human nature kind of pushes you towards that, thinking, okay, well, I've crossed a wider spread, but the market might just come back to me, rather than just locking in this kind of cost today, which is, I guess it's illogical, but it kind of plays into human psychology, doesn't it?
But I still think but what we're trying to do, I mean, we've had a lot of feedback from the market, kind of what they find important, and actually it's increasingly obvious that there is a growing demand for transparency, and there is a growing kind of, I don't know.
I mean, it's kind of what we're all about here, right? We're kind of trying to shine a light on all of these things and kind of bring transparency, and we're showing people where our own traders are see value, and in the process we're probably making ourselves quite unpopular in various swings of the market.
But I think but whether you like it or not, that is just the way things go, and that whole kind of opaque market, it just can't last forever. So we've always prided ourselves on being at the kind of forefront of that movement, and even if sometimes it appears that we're a bit early, and it's not always taken up so quickly, but we stick to that kind of transparent like ideology, and being very clear about what we're charging for things, where the bid offer spread is, any other charges. We don't love the idea of baking things into a cost, but we know that that's what some people want, and we're a client first business, so
absolutely.
We're happy to adapt, and credit lines that we offer are tailored to what customers want, but we always try and push this kind of transparent angle where we really want to be upfront with, we can charge a tight spread because we don't need these layers of middlemen, and we are the wholesale market. You know, when you trade with us, you're facing that kind of Onyx liquidity pool, which is, you know, they are the largest liquidity providers of oil swaps in the world, and you're kind of getting direct access to that liquidity pool. So we don't want to start adding layers of bid offer to that to make that not clear. But
yeah, exactly. I think, you know, obviously we're a trading business. We've always kind of felt, you know, we'd much rather make our money from market making, but we kind of appreciate the importance of, or the need for credit in certain areas. And where we have offered that in the past, we've always been very clear that, you know, this is how much you're paying to trade. And if you're being extended any credit, then this is how much interest you're being charged on this credit facility.
Yeah.
And those are two separate things. So you can, you know how much you're paying for one thing, how much you're paying for the other thing. Whereas, you know, the kind of bank model, whereas, you know, by the way, you know, that they'll probably be coming to someone like us when they need to flush out that risk anyway.
Yeah.
So you might as well kind of, you know, cut out the middleman by, you know, not going via a third party.
Yeah.
But also, you know, just be super clear that, you know, if you could see that markup that's being added onto that price expressed as an interest rate, it might be quite eye-watering to you, and it might make you kind of think differently if you said, okay, well, this, you know, X dollars a ton is actually like, you know, 20% annualized interest rate. And you see it like that, it actually becomes quite offensive.
Yeah, and we've done the maths, right? And we've kind of worked out that actually, like, it doesn't take to work out like a kind of annualized interest if someone's trading regularly. The kind of extra markup is not that high, which is why we want to, you know, we work so hard to provide tight prices, and then quite often, you know, the question comes back at you. It's like, well, what's in it for you? Like, why are you able to show this? Like, what's in it for you?
Exactly. And it's just, you know, for us, we're a market making business. You know, the more flow, you know, the better it is for us.
Yeah.
And ultimately, we've always been of the opinion, right, that just an efficient market benefits everyone.
But it also shows you that kind of the criticalness of removing as many kind of intermediary layers as possible, right? If there's like $1 spread at the end of the line, but there's 3 intermediaries, all of a sudden you've got a $10 spread. Because everyone needs to eat. So we're about removing as much of that as we can, and that is why we can show that price, because we don't have, you know, 5 mouths to feed on the way down. You know, we are this is the end of the line when it comes to liquidity. Like this is where the banks and the independent hedge providers are all coming to trade. So we just don't need to justify, you know, paying 3 different people to make the trade worth it.
Yeah, no, absolutely. And I think, I guess at the end of the day, you know, whether you want to subscribe to the Flux platform just to view prices for the purposes of benchmarking, or, you know, have a relationship with Flux markets for, you know, direct hedging, you know, it's all about just giving yourself as many tools as possible to make the best informed decisions.
Absolutely. Yeah. And I think like we've kind of noticed that area of the market that was being served, you know, particularly on credit lines, they were really kind of trying to pull the lever of opaqueness as much as possible, right? Because you want to kind of maximize the return. And we found, like, so far in this, you know, relatively new venture for us, we've had pretty good traction with, you know, these credit customers, because they are really benefiting from the transparency in price, the tighter spreads.
I mean, that's kind of always been our sales pitch, right? Because I mean, you can talk about these things sort of academically, and it's kind of harder to get the message across. But we've always been like, okay, well, next time you go to your current provider to get a price, you know, come to us at the same time and we'll show you our price, and then just, you know, compare the two, and then, you know, it should be quite simple in black and white.
Exactly.
Yeah. All right, great. Well, I think that kind of wraps it up really for this episode.
Yeah, it was always going to be a short one.
Yeah, great. Well, hope you can join us again soon, and we should have Julian back with us next week. Thank you very much.
Cool. Nice one.
Hi, welcome back to another episode of Trading Corner. So we're just going to touch upon the market, see where we've moved from last week. Seems like, 5 trading days feel like a month recently.
It's definitely felt that way, yes.
Yeah.
Especially coming into the changeover of the month and
Yeah.
all of the physical interests changing and what's been going on with Russia. It's been
Yeah, tiring to say the least.
exhausting.
Okay, so let's start with Brent, I guess.
Yeah.
Last time we spoke, we'd had a lot of short covering, although I think we were suggesting that perhaps not people hadn't 100% covered, given the sanction news that was coming out, a $4 rally in Brent flat price wasn't that aggressive.
Yeah.
Since then, we've softened quite a lot. Interestingly, on the whole curve as well, typically when you hear news like this, what you'd expect is perhaps the back of the curve to normalize a little bit, because it very much is a supply shock in the prompt. But actually all the spreads have given way a little bit. So it's been quite interesting. I think the market still is fairly confused.
Very confused. I was going to say, prior to the Russian news and prior to even our conversation last week, we moved from proper contango on crude spreads to proper backwardation. And now we've kind of settled, the prompt's still a bit backward, but on the future side certainly. And the rest of the curve it's super flat.
Super flat. It's quite interesting. You're totally right. Like before the sanction news came out, there was aggressive, sell side flow. Even the front spread was threatening to hit around flat at one point.
Yeah.
And since we bounced back, I think the markets found it hard to believe that the sanction is going to be a long-term or even medium-term issue.
Yeah.
I mean, the way the market's behaving at the very least, you would think that we're pretty good on oil around, and there's no real shortage.
I think so, and I mean you're seeing that with the amount of oil that's on the water, which is significant, which is keeping a proper bid on freight.
Yeah.
But let's just step back to what we talked about last week with India being the swing barrel, right? Because the rhetoric out of India has been also mixed. Like there's been some chat saying that they're not going to buy barrels, and then there's others that are going to buy barrels, and so it is a bit confusing.
Yeah.
But oil-wise, we have oil.
We have oil.
Yeah.
But, we're coming out of maintenance now.
Correct.
So we should be picking up on these crude purchasing. And that's still, from the looks of it, that has still not happened. I think we still have a lot of refiner buying to come into the market, especially in dated. I mean, if you look at the curve right now, so before the news hit, we were pricing around minus 20 cents on the physical diffs. We have rallied there about 50 cents up to 30 cents. But the whole of the forward curve is really quite depressed.
Yeah.
Given a strong backwardated market and the potential of the refiners coming in with the margins where they are and the Russian oil offline, the forward curve looks undervalued, 100%. So
the only thing I would challenge to that is though that I think the forward curve on a relative basis has been undervalued for a long time. Do you not agree?
Well, yes, for Brent, but actually usually for dated it's the opposite.
Yeah.
So typically for dated, our forward curve is always overpriced.
I see. Okay.
Because of the forward hedging.
Yeah.
And then when it kind of comes to pricing, typically this year at the very least, we've had the roll down. Whereas this time we've got the opposite. And it could be because the refiners are still waiting to potentially get the cheapest barrel that they can possibly do.
Sure.
But typically what we find when they do that is they will all come in at the same time, and they won't, it's hard to buy the lowest, even if you have some great foresight, but
they'll be chasing.
It typically
it feels that way.
Creates that environment. So it's hard to really look at dated and say it's a sell. You just have too many supply shock risks, I think, and with the margin where it is. I think the margin is extraordinary. You talk to any refiner, they're the ones that have won this year, right? We've had sustained, very strong margins.
Super strong margins. Just whatever crude is done, product demand is there.
Yeah.
Right, products being absorbed. All the refiner margin hedging, any margin hedging is just getting absorbed daily.
Exactly.
Almost, it feels like.
So it's quite hard to look at the dated curve where it is, with margins where it is, You know,
to be short.
Even regardless of what's going on with the Russian barrels, and if India needs to come and fulfill a short, it's difficult to say that there is downside.
Correct, and also it's interesting. I mean, over the weekend you had the OPEC meeting, and you know, it was quite
right?
super non-aggressive tone
Yeah.
of increasing supply, which has, you know, certainly been their strategy, or certainly been the tone for the last 3-4 months. So everything was in line as expected, and what was interesting was that there was some chat about not potentially increasing supply come Q1 because of the plentiful supply around.
Yeah.
Right. So, yeah, it's not clear. I'm with you on the margins. Like, the margins are strong. We're coming out of maintenance, and you could see refiners coming in to buy crude.
Yeah, I mean, on this curve, they definitely should be doing that. And then also we look at the other regions. You know, TI is doing okay. I think you know, all the stats last week were very constructive.
Correct.
So we were having really big crude draws. You know, let's see what happens with Venezuela, if that is, you know, material in any way really to the crude supply there. And the Dubai curve is back to normal as well. We priced 148 on the front spread today. First day of pricing, very, very strong.
Yep.
And the Brent Dubai is, you know, kind of back to normal levels of like minus $1.
Yeah.
So every other region looks okay. It looks like dated is the undervalued curve at the minute as it stands. Now,
sorry, go ahead.
no, I was just going to say, the other thing is, with freight where it is, the arbs are shut. Every arb is pretty much shut. And so if the demand comes from Europe, which I suspect it will in the next 2 weeks, it's going to be very hard for them to buy Midland, which is, you know,
move it over even,
but with the freight where it is, or anything out of Northwest Europe. I think it's going to be very expensive for them to do that, which means the local grades, Brent, 40s, Osberg, Ecofis, I think they will clear very easily.
Okay.
So let's see.
Yeah.
It is interesting. So I just wanted to actually show you this graph really quickly. So I've spoken about it before. I love to look at it. It's essentially the margin, which is, you know, this kind of 3D block line against the GFL. And it totally makes sense given where we are in the maintenance season that, you know, the GFL is a bit more suppressed.
Yeah.
But I do expect this relationship to start converging a little bit. You know, I think we still will see strong margins.
Yeah.
The reason for that is because the core of the barrel, so to some extent gasoline, but gas oil mainly, is very solid.
Correct.
We're going into high demand season for gas oil, so I think we will probably maintain those cracks there. And so it's the peripheral kind of cracks that's going to move the margins, so the waste products.
Or crude.
Which I do suspect that, you know, potentially naphtha. I mean, this is from a crude perspective, so
Sure.
give me your 2 cents.
I'll give you
as
the
well.
product perspective. Yeah.
I do expect that the waste products will probably be the ones to soften the margin rather than the middle of the barrel, as I was saying, just as we start running rates a bit stronger. And I think crude will start picking up a bit, which will help the margin as well. But I do expect that convergence there.
I think from the product side, it's important to note that a lot of the tightness is coming out of the U.S. You know, heating oil is tight. Gasoline in the Atlantic coast, it's tight, it's strong. So there's an enormous amount of U.S. related strength in products, I would say. Tightness exists across the world, but if you look at it on a product specific basis, gas oil, we are, as you said, coming into peak season, but we've priced an enormous amount of that strength already. And as we price it in the turnaround season, it'll be interesting to see whether over the next 6 weeks or so refiners come out to hedge further margins and how that would be absorbed in the product market.
Is the market long gas oil?
It's difficult to say.
Yeah.
I think the market's long gas oil structure.
Yeah.
And it would be, I would find it surprising I would find it surprising to hear if the market was short gas oil, because I think that would be...
Also, they've been burnt trying to do that relative value trade all year, right?
All year.
Yeah.
All year. Although I would say that, you know, it could... you could see an improvement in balances, and even if you drop a few dollars on the gas oil crack, we're still extremely strong.
Yeah.
Right. So I don't think it's going to.
That is the thing, you
It's
know.
just, we're still so strong.
Yeah, the difference between margins at $7 and $10, you know, the refiners will still be running 100%.
Absolutely.
So you're totally right. We can give up a few dollars on the margin, and nothing should change from an operational perspective.
Correct.
Okay, so it'll be interesting, and also we're coming into Thanksgiving, so potentially like local gasoline demand in the US will have that additional support as well. So yeah, I don't see the product demand going anywhere into the year end, personally.
One thing which I wanted to talk about last week, and I actually forgot, but it's super interesting because we're talking about crude structure being relatively flat outside of the front 3 months of the curve, certainly on a futures basis. You know, it's been, you got to remember that it's actually been a very, very long time, probably 4 years, maybe even 5 since COVID, that the market saw deep contango and product spreads, right, across the back of the curve. And if you're a physical trader and you're looking at any available contango, you're probably hedging any storage or pre-hedging any storage requirements. So I think a lot of the product strength can also be driven off just the flows at the back, and what's implied, which is super interesting. So that's actually keeping strength on the prompt margin as well, is the fact that the rest of the curve is offering storage economics for a lot of products that are at levels where physical traders haven't seen that for years.
Yeah.
Right. So it's a flow factor to keep in mind that's keeping strength at the prompt.
So the guys that, I mean, I'm assuming this contango that they're hedging is Cal 26, or is it further back?
It's not Cal 26 yet. It was 2 weeks ago when we were a lot lower on Brent, you know, near the 60 mark, and crude structure was a bit lower. But yeah, definitely Cal 27.
Cal 27.
Yeah.
So I wonder, you know, they've locked in certain levels. That volume should get exhausted, though. You know, they only have so much storage that they can put this product into.
Correct.
And so if the levels go through there, will they have to stop out and look for better levels, or?
Unlikely. They're probably going to scale. I can't imagine all of that hedging is done.
Okay.
I think it was there for a brief while, and it's already repriced higher. So I think you'll get weight on contango product spreads for a while until the product markets can actually, the demand stops at the prompt, I suppose. You know what I mean?
Yes. Exactly. Yeah. And I don't think we can really go into a truly bearish market until we see these margins low. It's really hard to play, you know, a really short crude view or whatever off margins at $10. Like, it's really hard to justify.
I agree, and also if you look at the products independently, as I said, we were looking at them last week. A lot of these products are trading quite independently now, particularly during that short squeeze when everyone was trying to cover short. But even after the market settled down a little bit, if you look at high sulfur fuel, things are pretty tight. I think if you look at and continue to remain tight in Europe and in the US. Asia is actually fairly balanced, I would say, in high sulfur. In VLSFO, we've had a big leg up in VLSFO, mainly probably due to freight, I would imagine.
So are we seeing East-West come off?
In which products?
Like gas oil, like the ones that will be exported out of the East? It's mainly gas oil, I assume.
Yeah, I mean, but there's Eastern strength in gas oil as well.
Okay.
So I think East-West is still negative.
Yeah, something does need to help the freight, right?
Yeah, correct. Yes, exactly.
Yeah, interesting.
And then, so we, you know, the fuel complex still remains tight. Gasoline it's still, I would say, fairly healthy. We've dropped a little bit. Naphtha, we've dropped a little bit, but again, fairly balanced, I would say.
And nothing material to the margins.
Correct, and a lot of fears around Dangote obviously being a large driver of the moves in the gasoline complex, and distillate is strong.
Yeah.
And so where are we going to give way in the margin for it to come off? And so it'll be interesting. I think you'll have to see something change on the product demand side to really, like you said, have a high conviction short on crude, which is I'm sure you've made this argument well before you and I started talking, and we're going to continue saying the same thing.
Yeah.
Yeah.
Okay.
Yeah.
So, I mean, other than that, other than the retracement in, well, I guess across the barrel, but predominantly in crude, it's been a fairly quiet week, I would say. I think volumes have really dropped off. It feels like the market is fairly risk off.
I would say so, yes. Especially with the uncertainty about what's going to happen.
Yeah.
And I think a lot of the product markets actually last week and this week were really driven off crude.
Yeah.
And crude has also, crude volatility has dropped off a little bit.
Crude's dropped off, exactly.
Yeah.
The price action in dated is getting a little bit more volatile because the liquidity is not there so much. But we had expiry on Friday, which was fairly constructive. We priced 65 cents roughly on the cash spread, which, given this forward curve at the minute we're seeing on deck barrels, we're pricing in around 30 cents. Mm-hmm. It was a strong expiry. We also had a lot of Jan EFP transactions. So I think the market does think it is worth owning barrels here with the margins where they are. It's just not come into the forward curve on the dated side yet. So for me, the only trade that makes sense is to go long Novdec. I think we're going to have, as I said, margin support purchasing from refiners. We're going to any potential supply disruption, knock-on effects from Russia, like if India come in purchasing, and also all the arbs are shut. So it's going to be really hard for TI to land competitively and fulfill some of the shorts. I think it's the only thing that makes sense.
Yeah.
Obviously, unless margins get clashed, but I just do not see that happening.
Yeah, I mean, look, last week I said I talked about being long general, Q1, Q2 product crack rolls, which is fine. I think I like that. But actually, having looked at the curve a little bit more across all products, the deferred margins like Q4 26, Cal 27 margins, those all look obviously significantly cheaper than the front, as we say, and actually the front is a little bit of a difficult one. Like you said, is it going to be products that correct down or crude that corrects up? And for me, it actually doesn't surprise me that the back end of the dated curve and the crude curve is a bit depressed, because I feel like with all of the rhetoric around the oversupply next year, it feels like it's more of an aggressive prompt roll-up than anything. So if there's buying in the prompt because of margins, as you say, it can just be prompt strength, and then we'll see next month.
Then we price that, exactly.
You know what I mean?
Yeah. The only thing that I don't love about it is everyone is short Q1 DFL.
Yeah.
And they're going to have... we saw some stocking out last week with the sanctions. A lot of deck Jan, Feb buying. People were definitely covering positions there. But I'm very much a contrarian trader, so I don't enjoy getting into the same position as the market. But sometimes you just have to. I mean, it's... especially when it's behaving
sensibly.
Not so much sensibly, as in just numbers do not matter. It's flow, and flow is dominating the curve. People need to enter or exit a position. That's it. They don't care where the value is.
I 100% agree.
So I think that's very much the scenario we're probably going to remain in.
Over the next 6 weeks or so, into the new year, I would say. I think flow is going to dominate into the new year.
For sure. Okay, well, saying that, I think we know what my trade suggestion is. What's yours?
I actually am going to say that second half 26 cracks. I would say across second half 26 margins, buy.
Oh, buy. Okay, cool. Yeah. And mine is Novdec dated. So let's see how we are in a couple of weeks' time. Thank you.
Cheers, thanks.
Hi everyone. Today I'm joined with Martha Dowding, who is a research analyst and Flux Insight team. And with the Flux News launch, we're going to be doing more and more on weather. So we thought we'd start with an introductory discussion around weather patterns and which specific weather events obviously impact the trading market in particular, some of the historical moves, and then thinking going forward and kind of reviewing the year as well. So Martha, do you want to take us away?
Yeah, of course. I think we're going to keep it evergreen today, but just for context, we're coming to the end of the 2025 hurricane season now. And this is a graph of all of the hurricanes that there has been in the Atlantic this season. And as you can see, it's been a pretty lucky time to be living in the East Coast of America, bad time to be a fish, and lots of these kind of fish storms. So we have seen lots of the usual hedging from players kind of amount to nothing. So that's being taken off now. So I thought I'd have a look at some of the usual impacts on crude and a couple of products for some specific hurricanes.
It's just butting in straight away, just because gasoline has had a big move, particularly in Europe. And I guess there's a lot of things going on there, but you would expect if you looked at it on a graph and during the time, a hurricane must have kicked off.
Yeah.
Not at all, right? So it was a very
people have such trust in forecasts because of the way that weather works, that people start hedging ahead of the hurricane. So it's not like it happens, then all of a sudden there is panic buying, although we have seen that quite a lot. So we do see kind of the build up to it, and especially the later in the season it gets, the more it's kind of like, oh, we're finally going to get a hurricane. We're finally going to get a hurricane. We did kind of see spurs of buying because of that.
Okay. But you have to say kind of a bit uninteresting from a seasonal basis, no?
It's interesting because,
market perspective. Okay, so leading in. So
this is just purely why this is just for me to talk about the weather for a minute. So there was the high pressure center around Bermuda that was a bit lower this year. So as you can see, that means that the path that the hurricane would take from the coast of Africa is going to be more to the east and a bit more north. And there was also a kind of a front of low pressure over the east coast, which kind of disrupted that as well. So that's why we saw this, like, it was just an incredibly lucky season, I'm sure. Incredibly lucky season.
Okay. So I think we have to say as well, like, newcomers, whatever, but we know with hurricanes, it's about what the hurricane impact actually is. So it's always a bit confusing. Is it going to hit infrastructure like a refinery, and then that's kind of bearish crude because they can't buy the crude? It's bullish product because they can't make the product. Or is it taking off storage, or is it going to be demand destruction? That's what's always confused me a hell of a lot. Like, okay, there's a hurricane, but we don't actually know what that really means. So traders are always looking, aren't they, for the path and what?
Yeah, that's exactly what the most important thing is. And that's actually a great lead into the first hurricane we're going to talk about, which is Hurricane Ida. As you can see here, in 2021, that hit exactly where Mars crude in the States gets pulled out of the Gulf of Mexico, Gulf of America. And you can see there's another graph here showing exactly all those offshore drilling had to be evacuated, it got shut in, and as well as seeing the usual effect on the WTI spread, which is kind of a softening of the spreads, as you can see. So usually in hurricanes generally, you do see a softening of the TI spreads because, as we often talk about, WTI has a tendency to kind of pool in place when they can't export as much. And if there's any damage to kind of infrastructure, refineries, you can see a few examples here, and also a little chart of why the spreads do suffer. So as well as seeing that in 2021 with Ida, the impact that the hurricane had on the Mars grade specifically was really clear.
Yeah, very bullish. Which, it obviously makes sense. You can't get access to the Mars crude. It's going to go big. But again, it can be confusing because obviously the weakness in WTI is because it can't export. So you have to get that nuance right, and it's not like a repeatable trade. Just nothing else to say. It's why I don't think people really like trading it, because it's so randomized. But I guess what you can do when the hurricane is forming and when it's becoming closer and closer to impact inland, you can at least look for the momentum trades, right? You can look for what's starting to react and what people are starting to gauge. And I mean, that's a half decent trend following trade. Like, you can see it here. I mean, it's rallied 250 all the way to flat. So that's per barrel. So it's quite a lot of entry level to get in and ride that up as that was moving. That's the only thing I can really say there.
Yeah, this was the largest, clearest impact on this specific differential that I saw, but you did see it kind of inching up when you see the path leading into the Gulf of Mexico like that. I think it's quite a niche trade, but it's interesting.
It's a niche trade, but because it's a niche trade, it's very specifically what would impact the market from the Mars terminal going down, obviously the Mars differential. So that's quite nice in a way. Whereas WTI spreads, of course, you've got a lot to contend with. And if it's not a minor hurricane, but it's something that will cause days of damage rather than weeks and months, like, and obviously some of the more extreme scenarios, then you're a bit like, well, you know, am I going to sell WTI spreads maybe on the backdrop of a very strong Cushing market, and there might be a big draw in the EIAs? So again, maybe another thing that probably comes up in the history is, if you can find those niche expressions that are kind of binary, those are the ones to stick to, but it's all about execution, isn't it? So.
Yeah, and I think with the crude differentials in particular, they kind of get up and running a bit faster than getting a refinery up and running as well. Right. So I think that may also lead people to be a bit cautious down to trades like this.
Okay, so Ida hit through Gulf America or whatever, so, and hit the offshore platform. I remember it myself, 21. It's all, you all hear the whole, right, they're exporting, they're getting all the people off the Mars platform, evacuation, and that was the clearest thing. But it did reach inland, did it?
Yeah, of course. So this is the path here. We saw it kind of move over Louisiana.
So right in the Gulf Coast, which is where all the major refineries are.
Yeah,
in the US.
so there was refinery issues too. So there was 2 million barrels a day of capacity taken online with some big names there. We've got the Marathon, Garyville, Motiva, Valero. So like these big names you hear a lot in gasoline as well, which we'll get to in a second. But so you can see 60% of the US Gulf Coast production was shut, with 1.7 million offshore crude halted. Yeah,
and again, so it is quite niche, the Mars grade again. But the thing is that the US is very sensitive. The US crude market is very sensitive to the sour grades that they need to blend in, right? So we saw that with the tariffs this year. You block off Canada from exporting their oil sands down into Cushing, and it really screws up the refineries on the East Coast, right? That's what they rely on. And then it actually was very bullish gasoline. Like, there's always knock-on effects. So Mars might seem niche, but actually, you know, it's got to be replaced some way for the Gulf Coast refiners. And who knows, it might have caused like a few knock-on effects. Maybe you don't have that right here, but
it'd be interesting to look into with those heavier grades.
So what about the product side? Because it did hit a refinery, as you said, or it did at least take capacity offline. So it's all about the production there, of which obviously the US export products, but they also export internally, domestically, right, up to New York, which is a big deal.
Yeah, so I think like looking at the New York Harbor, US Gulf Coast differentials for gasoline, that's interesting, but we don't really trade those so much. So I did try and keep it looking at the ARB between the US and Europe. So you can see here the graph of when the hurricane hit. We can see that jump in RBOB, which is this green line. It's kind of, I think because it's in September, it's kind of, we're expecting a hurricane to come. And I think there'd just been one a little earlier in the season, a bit less strong. There wasn't the kind of significant jump in prices that I was expecting, but we did see this kind of trend down in the ARB, the gasoline ARB, after the other gasoline the other gasoline focused like little study I did as well. So that must be something that kind of to expect, because that's a fairly significant drop.
Yeah, and again, it's the backdrop of positioning as well. Like I actually put that in my book. It was one of those ones where, you know, you expect refineries offline, bullish gasoline, but if everyone's been expecting it, that is the thing with hurricanes. You do get quite early warnings. You know, it's weeks you can be
you can obsess over it.
Yeah. So I think by the time it actually hits and there's the expectation that it's going to get hit, or a high probability it's going to get hit, then you're probably going to have RBOB positioning in there already. So, and if it hasn't really moved up towards that, you're probably getting a lot of sell side resistance. Is that because people are taking profit on the rally? Is that because people don't believe it? Whatever. But it's a very difficult one to be early to, I would say. But the knock-on effects, a lot of the confirmation, you again can maybe get from the more niche trade. So the ARB, again, that's probably a more higher percentage trade, because if it really is cutting off some restricted gasoline, it's probably not a huge deal for the global pool of gasoline, but relative on an export basis, of course, it's going to cause disruption. So a higher percentage trade will always be, in my opinion, like the ARB going up, right? A relative value trade, or down, depending on what we're looking at here. But I think, I don't know, that's kind of my anecdotal point of view on that.
I think people point to it being priced in very easily, and it's the kind of thing with the same thing we see every week with the stats, when people are like, should have gone up and should have gone down, when it turns into kind of a liquidity trap, and it goes up to such a level that, oh, this is great to hedge out, and then you see it come straight back down.
Or, you know, the thing about sell the rumor, buy the fact type psychology, you know, you see it a lot with the EIA stats. You've got Genscape coming out on Monday who kind of preempt what the EIA is going to say quite accurately with their satellites and whatever. you see the market react or position for a stock draw or whatever, and if it was a hurricane, it's a hurricane. And then when you actually get confirmation in the news, they use that as a liquidity event.
Yeah.
So again, it's difficult in this kind of game because you're always playing that lead lag between the people who have the information right on hand, or have literally been speaking to someone being like, I'm on the Mars platform, I'm getting taken off. Do you have that kind of instant access to that information? Anyway, let's move on because this is that was quite detailed.
And this is just more as to why there was not a huge difference in price, why there was kind of cushioned. You can see stocks were decent. There was no huge power outages, and I think Colonial was off a little, but it wasn't as badly as we'd seen other times, although that can also be quite unpredictable, the effect that has on gasoline too.
So do we have a hurricane which really caused shockwaves in the market?
Well, yes, we do. This is the Hurricane Harvey from 2017. This one, as you can see, inland, really significant, not a huge path, but pretty powerful. This took more than double the refining capacity online. About 25% of the total US refining capacity was taken online by this.
Wow. Okay, so there, I'm obviously assume, I can't really remember it because 2017 I was definitely trading crude, but I mean, Omar must have been trading gasoline at that point. So what did happen actually? I can't remember.
So let me just check the dates. Yeah, so this is late August. This has a much clearer rally in the both EBOB and RBOB cracks into the end of August here. And then again, it's got sold into, whereas this had less of an impact on the ARB, I think because I'm not too sure why, but I think it did still see that drop afterwards, like I said previously. But I think for this one specifically, with such a huge amount of refineries down and the amount of time it takes for refineries to get back on track, making gasoline of good quality, we did see this really significant rally.
Well, it looks like we had quite a bit of volatility on the ARB as well. So that looks like a choppy one. Again, given its extremity, I imagine there was a lot of aggressive positioning. So yeah, the bigger the hurricane, the bigger the event, the bigger the expectation and positioning and volatility. So that makes it even more tricky, which again, like, you know, I would have said high percentage trade is what I just said before, but it looks like the ARB was as choppy as anything else. So probably quite a tricky one. Be interesting to hear from somebody who's actually trading that what they think, but I don't remember. So yeah.
So that's for gasoline. And then for LPG, it's similar with the import-export situation of the States, of it being easy to pull, LST in particular. So this is looking at Harvey again and Laura. So with Laura, the problem with so many of these things is to isolate a cause and effect. There's obviously a million other things happening at the time. So with LST, the LST FEI differential, which is what we usually look at to measure the strength. You can see here, this is taking some of our Flux data and historically. So Hurricane Laura was in 2010, so that's the yellow line. You can see that's seasonal highs, that's all-time highs for the LST FEI contract. But we can say that...
Sorry, 2010, what happened, sorry?
2020, it got sold down to from there, which you can say it was because of hurricanes. You can also say it's because the Panama Canal was very congested. And there was just a whole series of reasons to start selling this, and also they're extremely high prices. But that was a pretty significant drop from Hurricane Laura added to that as well.
Got it, okay.
And Hurricane Harvey, which we just mentioned, that's just a similar thing. We see fractionators down on the coast, which means that you can't export gas specifically in the right, C3, C4 amounts. So we can see pooling of propane in the States as well in LST, and we can see pressure on the ARB from that.
Okay.
You can see that here in late August of 2017.
This is going back to Harvey, yeah?
Yeah, this is the 2017 Hurricane
So
Harvey.
we were pretty damn high on the ARB actually, or at least if you compare it to these days, but it came off a cliff, right?
Huge drop there,
So in terms of higher percentage trades, then that's also a pretty decent one. I much prefer these export differentials in weather events like this, because it's just, it's temporary, right? It's never going to be like, well, no, I shouldn't say that. It could have huge knock-on effects, and they have been in the past, but generally speaking, you get these flash events, these weather events that quite consistently, and there's going to be disruption, but you want to isolate exactly where the disruption is, get that highest percentage trade as possible, like we said with the Mars TI. So you've got to look at these things. And actually, LST FEI, we got big in propane kind of like 2018, 2019. So this is just before that. This is the kind of thing you would be expecting to have a lot of positioning on, given its kind of predictability. So that was interesting. So that's hurricanes. That's kind of summarize hurricanes, and just I guess. Just to finish off the 2025 part, you do get these indications early on in the year that this is going to be a year for hurricanes and that kind of thing. Wasn't that said this year?
Yeah.
And that's because of the
Sea surface temperature, the second highest it's ever been, with the highest last year. I think we're the one or two of the highest at different points of the time. But it just shows that we're all kind of at the mercy of more than one predictable thing. We can see that the surface temperatures are so high, but without the correct path and without the pressure differentials being, in your favor, you're not definitely going to get a hurricane. And I think we're getting
even
better.
If you do, is it going to be a hurricane?
Yeah, so we had really strong hurricanes, but they just were at sea.
Okay, so that was hurricanes. Moving on to, I guess, something quite important these days is heat.
Yeah, so we've been seeing a trend recently of extreme heat in the summer. I think focusing initially on Europe, I think last year was especially hot in 2024. And then prior to that, I think the most significant heat wave was the year before in 2023. I think we got off fairly lightly this year in 2025, but it's still really important to have a look at the kind of effect on the European infrastructure and products, power and gas and electricity, because not only is this part of the market, but this is something that directly impacts the consumer and everyone watching this. So 2023, looking here, because this was especially hot, we can see the Med refineries were forced to cut up to like a third of their production over the summer. So Macquarie yeah, thank you. Sorry. Said that heat-related disruption reached about 1 million barrels a day, which is about 10% over the whole year. So this is really, really impactful numbers, and it impacts different refineries in different ways because of the different units, ability to kind of handle the heat. I think when you look at heat and you look at hot weather, the most sensitive would be the FCC, the fluid catalytic crackers, which make gasoline and other, smaller hydrocarbons, and also hydrocrackers, which also produce gasoline. So it's really important to kind of have a look at how these are going to be handling it. Refineries in Europe aren't built to handle the temperatures that, say, refineries in the Middle East are. But even now, I've heard reports that like this year, during the 2024 summer, 2025 summer, they were going to have to cut some of the run productions from in the Middle East, and their whole refinery system is built at a different pressure so that it can handle temperatures up to like 55 degrees, but temperatures are passing that now.
Yeah. I think absolutely topical. I actually remember now, like 2023 was such a basically market move in the products because of refinery fires, refinery overheating, and there being issues in the US as well, right? US and Europe.
Oh, definitely, yeah.
And so given 2023 was quite a difficult year in terms of predicting outright price towards the end, I think it was starting to get a bit more uncertain. I remember coming into 2024, there was an incredible amount of like Q3 buying, basically predicting another heat wave disruption. That was like the leading narrative. And I guess the global warming narrative that you hear all the time, and because it had happened in 2023, people were getting really overhyped for that really early doors. And you just got a massively oversaturated product market in 2024 for the summer, way too early. I remember Bloomberg reporting about record open interest Q1 for this type for these contracts for products. And it didn't materialize. And when it doesn't materialize, everyone's expecting it. And obviously, it's a bit of a bloodbath, or makes the market difficult, if you like. But it is funny like that. Like, even it's almost like anything we do, if things are so expected, they tend not to happen, right? but having said that, the other side of trader psychology is if it doesn't happen, you think, okay, it won't happen, but then it rears its head again. And there's all these things you always forget. Like, if next year there's hurricanes that impact inland, I mean, recency bias, I haven't really, it's been a while since there's been a big impact. So if something happens now, I think there will be a lot of people on the back foot, and it will be a lot of volatility. And I think the same to be said about heat, you could say.
Yeah, it's interesting because looking at kind of the chemical engineering process, it's going to be less efficient. There's going to be optimization issues because the FCCs aren't able to cool themselves as they should because ambient temperatures are higher. That doesn't mean that there's going to be fires. That doesn't mean that there's going to be huge issues, but it just makes it more likely. Same with the hurricanes. Nothing is an inevitability. And I think when people get overconfident, that is how, that happens, how you said.
And this year, there was, as you say, we got off quite lightly in Europe, but there were pockets of this extreme heat. And in particular, the one that stands out from memory was in France, the nuclear power stations, like the water around it, like the river, I guess, or the surrounding water got so hot it couldn't cool down the nuclear reactor. So it really caused some volatility, at least in the electricity markets, power markets. But as you say, like the inclination there is like you have your energy stack in Europe, right? You have nuclear power, you have coal, you have oil at really kind of extreme. But either way, when something goes out, it is an outage nonetheless, and you have to put pressure on other substitutable commodities. So it's always something to be super aware of, even if you're an oil trader and saying, what do I care about nuclear?
Yeah.
It does have an impact, right? Something to be aware of. And as you said, going forward, more and more, this is likely to happen. So.
Yeah, I remember you saying on the podcast last year that people say nuclear is this kind of like magic response to kind of global warming and everything, and people using coal again. But because of the state the world is already in, the cooling facilities aren't really possible, and there are such stringent regulations in Europe that you can't be discharging water at a certain temperature. In France especially, it's really quite low. So I think if we're seeing nuclear build up more, we might have to see a bit of a drop in those regulations.
Interesting.
So looking to the Middle East, we saw a kind of different demand in this summer and also last summer kind of rear its head. We saw a lot more fuel oil demand, so high sulfur fuel oil.
It's air conditioning story, right? This is now a big theme for the market as well.
And it was definitely like one of those narratives picked up by the media, and we saw bunker demand increase as well. But there was this aircon story that people really latched onto.
Yeah.
So you can see, looking at the graph here, the 2025 seasonal highs, all-time highs in the 3.5 barge crack, which is the Euro high sulfur crack, and it's especially obvious when you look at the east-west. So the difference between the 380 in Singapore and the 3.5 barge crack in Europe, that got to new seasonal lows as well at the end of July because of this like really high demand coming from the Middle East.
Yeah, and just conversely to what we've been saying about hurricanes and the unpredictability, even of heat in Europe, I think the air conditioning story it's a lot more structural, if you like. It is every year. And I think it's almost just something that the countries like Saudi Arabia are very keen to do, right? It just makes sense for them to be exporting less fuel use whilst it's obviously cheaper than crude, and they can play around with the exports and what they're doing. That draw on fuel oil is going to be, I think, something quite staple in the market, and therefore probably quite likely to be priced in quite regularly, a bit like 2024, like I was saying there. So, but still a good one to point out. But I guess if you were trading this, the stuff in Europe, you're probably more looking at electricity prices and gas prices, a bit harder maybe to trade that on an oil basis.
Yeah.
Unless there's a refinery fire, particularly from the US or that kind of stuff, then the obvious happens. But yeah, as I say, the more structural one to look at is probably fuel oil then.
Yeah.
In the summer. Okay, so that was the hot. What about the cold?
So looking at the cold, we're going back to 2021, which was a rough year. So we're looking in the States at, we had this storm Ida, which we've seen the phrase actually last year as well. I don't know if that's just when I became interested in weather, but this kind of polar vortex, this cold air being pushed down from, the Arctic down into the United States. So, through Canada. Just basically a quick description is that you have the polar vortex kind of spinning around the North Pole, and then you've got the jet stream below that, still like 5 miles, I think, above the Earth. But when the polar vortex weakens, the jet stream weakens, and that cold air can kind of pass down. And this was especially bad in 2021 during the Texas freeze, Ida, because there was this area of low pressure over the States as well, which is spinning anti-clockwise. The polar vortex spins clockwise, and that meant that
carnage happened.
Yeah, carnage
So this
happened.
this is what year?
2021.
Okay, 2021, because the Texas freeze that I thought, maybe that was 2021 as well, but the one that we had in 2023 and into 2024, I think we at Onyx probably know all too well, because that was an enormous impact on propane, actually, right? It got so cold that you had the wells being frozen. And that was pretty unexpected. We got crude rally. We got the WTI kind of differentials going a bit around some of the Texas areas. They're all kind of predictable on that front. But I think the propane one, we thought there was so much supply at the time. It was just not as expected to be so bullish. And I think we'd already had quite a big ARB rally. We'd already had quite decent spread rallies. So for it to really go on from there as much as it did, that was a blowout performance really for the propane markets and caught people by surprise. So again, it's a repeated one. When you see the Texas freeze, there are well, you can tell me, there's probably other trades, but for me, it would be straight to propane now. I'm always thinking.
Yeah, straight to propane. And actually, we'll come back to this a bit later when we talk about La Nina, which we're talking about with the trader kind of chat the other day, which is another really interesting way to kind of look at the intra-United States contracts, the regional contracts as well. But yeah, this is just an example of the electricity at the time, ERCOT, which is in charge of the grid for Texas, because it's not connected to the rest of the country, I don't think. They basically from 2021, in 2023 and 2024, there were far less severe power outages, which because after 2021 they were in such bad trouble that they had to weatherize, is what they called, the whole the grid. So that's meant that there was a far less significant impact on power prices.
But propane there was. And
Yeah, that's different.
On retrospect, yeah, it was potentially, of course, the cold, right? Propane used for heating in homes. But I think the wells freezing, at least from memory, was the unexpected one. How can it be that cold that literally you can't even produce this stuff anymore? That's pretty nuts.
Yeah, that's
Yeah.
and they're just not used to it. But this actually leads pretty nicely on to talking about La Nina, which is happening this winter. So you can see this is to do with the ESNO and like complicated weather things. But it's basically in each season, you're either going to get La Nina or El Nino or nothing, it's neutral. Right now we're in La Nina, which has been confirmed for winter. So looking at the United States...
Sorry, what's the difference? So La Nina is basically this, as you've got this chart here.
Yeah, it's to do with the ESNO, whether it's positive or negative around the equator. There's this...
What does it literally mean? You get a cold...
Yeah, so this is the typical weather pattern of La Nina. Generally, you're going to get a colder... Like we just said with the polar vortex, the jet stream is less consistent. And as it's more variable, we expect colder air to be pushed down from the Arctic down lower into the states, where it's a bit warmer at the southern states. So this is kind of the expected pattern. And because of that, there's this differential in the states called the north-south differential between Conway and Mont Belvieu LST, which I think could be a really interesting thing to keep an eye on,
super
especially...
niche, though. Hard to trace.
Very niche, but...
Yeah, no, look, you can get some stuff off. And yeah, that is interesting. Sorry. So again, La Nina versus El Nino. One's basically La Nina's creating this pattern, and what's the difference with El Nino?
That creates just a completely different pattern. I don't have a graph for that right here.
But sticking to La Nina then, yeah, it's cold where, sorry?
Cold coming in from the north to down.
Yeah.
And then it should be, and also...
So basically you're bullish to north-south.
Yeah.
Bullish to north because it's obviously colder.
And also there will be an impact. Propane is used a lot for crop drying.
Yeah.
So the crops will be wetter and colder and they'll need more propane to dry them around the Corn Belt, around the Midwest, which is where it will be colder and wetter.
Interesting. Okay, and more domestic demand, I guess. And so just generally quite bullish, but particularly the north. Okay.
Yeah, sorry, that's very niche.
Cool. Yeah, no, that's good though. I mean, again, this is the thing. So like we keep saying on all these different ones, if you want to know what's the real impact on the market, I think you are looking at the niche differentials. So you look, okay, and I remember doing it myself. So what's really going on here? We were like, okay, if there's real wells being impacted, like where is the main concentration of propane being produced? It's like, we're going to look at the Conway contract, not the LST. We're going to look, and I know it's a niche differential to LST, but we want to know what's going on there. So that will give us an indication, is this real physically or not? Or is this just, just a bit of hype and just a bit of positioning and speculating? And that's a really important thing to do. So it's just another reminder. It might seem super niche, but you hear La Nina, you look at the propane markets, look at the north-south differential to get your indication that it's real. That's very fair, I think.
Yeah, and of course scale matters. So if it's colder across the whole country, then there should be more demand for the whole propane market in the States. But
fair.
So lastly, just looking at cold weather in Europe, this is the graph of the LNG stocks year on year. As we can see, we're not looking super high right now. Of course, we're still,
Yeah, this is EU, right?
This is the
There's
EU.
all this talk this year is like, are we going to mandate the 80% storage that we have done before? Market was getting quite excited about that in that market because, it's basically essentially front run that, right? Like the front run the storage, but it got relaxed a bit in some I think some EU states, but whatever. The point is that was a factor. But I think what's super interesting about the storage and about the LNG story is that because LNG is replacing obviously a lot of Russian, when we had sanctions just yesterday, right, they're able to have these renewed sanctions because they've stabilized their supply, particularly for LNG from Qatar, from the US. so they can then squeeze the Russian supply again. So it might not seem like it impacts oil, but as in what's happened is because Europe are in a position where they're happy with their LNG storage, because it's cold, but it's not that cold. No one's too worried. It probably had a part to play in how they were able to go after these big oil and gas sanctions in Russia. You should never not look at it because it's political, right? Markets are so political these days. It's incredibly important to know what's happening in these core markets, even if they're not directly in oil, for this exact type reason. That would be my addition. But generally speaking, it's cold.
Yeah, I think we're expecting a colder winter because of La Nina.
Okay.
But we're looking at decent levels. Like it's not like stocks are on the floor, like 80 something.
Yeah.
And we've seen there are more LNG kind of facilities to get all of the LNG that America's trying to ship us being built year on year, and consumption's trending down year on year. But we saw a spike the other day of just some stats coming out. They're a bit bullish and prices, jumped up. We're in a really reactive market, I think. Right. I think TTF is really, really reactive.
Okay, understood. Well, Martha, that was great. Thank you all for the summary, and thank you for the whole summary. But I think just to conclude a kind of major themes there, I'm just going to repeat it because it's one of those things that you want to say, okay, I want to buy or sell something liquid when one of these things happens. Whether it's a very evidently a niche thing, even hurricanes, heat, cold, whatever. It's always but where, what's it specifically going to impact? And again, I would always reiterate. If it's a physical impact, you got to look at the physical market. You got to look at the differentials that are going to affect the physical market. So that would be the export differentials, like the ARB gasoline from US to Europe, or the other way around, Europe to US. We've got those North-South Conway. We've got all those kind of differentials like the Mars WTI for exporting. That will give you the confirmation on the physical side. Then obviously when you're trading the derivatives, you've got to weigh up other things like you always do, positioning and flow and all the rest of it. But at least you should know from these indications whether the story actually is real or if it's just a rumor. And I think that's kind of like the main message. And then trading off the back of it, I mean, I don't think we've been super clear how to make money out of that. That was not really the point of this, but maybe that's something we can do in the future. But generally speaking, there are key contracts. The air conditioning, it is about the fuel oil market mainly. Hurricanes, it is a lot about gasoline and maybe Mars and WTI to some extent. The cold, like you said, in Europe, it's really more about electricity and gas.
Yeah,
but propane in the US. And I guess it's just having that up as an event trade or something you're looking at. In the case of, have up your list, hurricanes or whatever, these are the key contracts you've got to look at. And that will repeat itself all year round, every year. So cool. That was a great introduction. You'll be doing some weather shows going forwards. And obviously, whenever anything happens that is significant to the oil market from a weather perspective, Martha will be there. So thanks for listening. I hope that was interesting, and see you again soon.
Good afternoon. We're coming to you live from the Flux studio, where we've just received ADNOX OSPs across Merben, Umlulu, Daz, and Upper Zakum, and they've been pretty big, haven't they?
Mm-hmm. Yeah. So the first thing to look at, if we look at the breakdown, is the Merben number, of course. Now, Merben for ADNOC is used as the benchmark, and we can see that the December number is 65.79. Now, that's expected because Merben is set at the average of IFAB Merben futures trading for the month. So that's not unexpected, but it's a big drop of $4.43 per barrel. So Merben is significantly weaker.
But I mean, the big number here really that I'm looking at is Upper Zakum, down 70 cents on the month, a full $1 below Merben.
Mm-hmm.
Now that's pretty cheap. And we saw that Upper Zakum was the key delivered grade last month. Mm-hmm. I mean, what's that telling you?
Yeah, well, if you have last month 33 convergences in Dubai window, 27 of those were Upper Zakum. That tells you that Upper Zakum is pretty weak at the moment. Tells you people are trying to get rid of it as the cheapest grade deliverable into the Dubai benchmark. So this month-on-month weakness, which is 70 cents lower versus Merben than it was in November, that's not entirely unexpected, but it is extreme.
And on a premium basis, Upper Zakum was down about $1.70, wasn't it, Ed?
Yeah, so the way you can look at this is by looking at the Dubai premium and then looking at Upper Zakum in relation to Dubai. Yeah. So if you look at the Dubai number here, we've dropped by $1.60 from November to December delivery barrels. And that tells you, obviously, that Dubai structure has weakened. But by looking at Upper Zakum versus Dubai, last month it was about 10 cents lower. This month it's 20 cents lower. So that change is even 10 cents bigger on Upper Zakum for the implied physical premium than it is for Dubai.
Definitely. And I mean, now the question is, what are Saudi going to do? I mean, so there's a few different ways that Saudi have been calculating their OSPs for Saudi light into Asia. Sometimes they'll use the average of the final week of the month relative to the final week of the month prior in the spot market, the physical premium. Sometimes they'll use the full month average. If we're looking at full month averages, of course, we're seeing a drop of 160 here. That's a huge cut. If they go in line with Upper Zakum, it could be pretty big. If we're using the weekend averages, it could be flat on the month. Yeah. The market is split. I mean, we did a poll earlier, and the submissions were pretty varied.
It's pretty varied. At the moment, it looks like the majority are voting in favor of a $1 to $1.50 cut, but it is pretty split. We have a lot of people saying it'll be 0 to 50 cents or 50 to $1. So that's one to keep an eye on, and we're expecting that will be out shortly this week.
Hello and welcome to the latest episode of the Hedging Show. I'm Tom Fawcett and I'm joined as usual by Harry Campion-Evans. No Julian this week. I think he's on holiday.
He's on holiday. He's having a well-earned week off.
Yep, taking advantage of his newfound celebrity status. This week we wanted to talk about marine fuel hedging and why credit is an important aspect of that industry, but why certain participants don't always know the true cost of that credit.
Yeah, we thought we'd sort of try and lift the lid a little bit on the kind of opaqueness of the credit industry and why it's so important in shipping anyway.
So I guess that's a good starting point. So why are these sort of shipping companies so reliant on credit?
So, as I understand it, in the shipping industry and like maritime industry in general, you have long payment cycles.
Yeah.
You've got a lot of operational costs which are paid up front, and generally it's quite a tight margin industry. You've got quite tight margins on sales of bunker fuel. It's very competitive, but I think more importantly, it's the payment cycles of the industry kind of lend itself to this kind of credit, methodology, I suppose, where you've got, transactions need to be smooth at different ports, like everything needs to keep moving. A lot of the cargoes that are being moved are paid for on delivery, whereas the fuel is being consumed on the journey. So you've got that kind of mismatch in, paying for something up front, but not collecting the revenue for what you're actually delivering until later.
Yeah. So I guess it's kind of similar to what we talked about before in the aviation industry, isn't it? Where you've got these like particularly low cost carriers operating on super tight margins, wanting to hedge out, a long way into the future.
Correct.
Because those margins are so tight, they need to be able to defend them, but they don't necessarily have the liquidity available to be able to fund those hedges.
Because as we kind of discovered, the airlines don't get paid until the flight's actually landed. So that ticket you think you've bought for a year ahead, they have to kind of lock in the fuel cost for that, but they don't actually receive the cash from the ticket sale until the flight's taken off or landed. And it's just like the payment cycle thing. It just doesn't kind of match up. So if these marine fuel suppliers and consumers are paying upfront or depositing collateral for a hedge of something that they're going to use in the future, none of that kind of cash that will be like a receivable they won't have any of that cash received. So there'll be a huge mismatch and they'll basically be operating as like a bank almost.
Yes. Yeah. So, and I guess it kind of brings us neatly on to why sort of banks have been quite dominant in that space, kind of, plugging that liquidity gap.
Yeah.
So they provide a lot of the hedging services, don't they? Even though they're not, natural liquidity providers in that space, they can leverage their balance sheets in order to provide the credit for these shipping companies to hedge against.
Yeah.
But they're not always, I'd say not always is a bit generous. I think they're very rarely transparent about the actual cost of that, are they? They're typically kind of showing an all-in price, which has got some kind of, markup.
Yeah, and it seems
baked into it.
Yeah, and that could be, again, we don't know always how transparent they're being with the customer, but it's not just the kind of, there's obviously the bid ask they have to cover and the internal cost they have to cover, but there's also kind of credit risk. There's all these layers of like risk which they're trying to bake into one price. And like obviously as you keep adding these layers of cost that they're trying to bake in, you just keep getting more opaqueness. Which suits the provider because they can just keep justifying like a wider spread. But it also, and what we've kind of also learned recently is that it can give the illusion that services are being provided for free.
Yeah.
And then it's like, you just pay this one cost and everything's free. And it's like, well, how, because everything's not itemized, you're just saying, well, it's just a bid offer spread, but actually like it's not a bid offer spread. You're just kind of charging everything on the execution.
Exactly. And it's like all these things, nothing's for free. So it's like, if someone's offering you a, commission-free stockbroking, for example, they're making their money somewhere else.
So that was the thing with Robinhood, right? It was like commission free and everyone jumped on it, but then it just turned out it was like at the post office when you do your money, it's just, you just get a crap rate.
Yeah, exactly. You're being shafted somewhere else basically, aren't you?
Yeah, exactly. And no one's going to lend you money for free.
Yeah. And I guess where the banks have been able to kind of take advantage of this in the past is there just a lack of transparency in this industry. The companies hedging didn't necessarily know where value was. So if you showed them a price that was, broadly where they expected it to be, they don't know whether they're paying, like $1 a ton above value, or $5 a ton or $10 a ton above value. And that's why having access to something like the Flux platform is so valuable, isn't it?
Yeah, absolutely. I mean, it was not in their interest to give transparency, but it also, the fact that the business was going on for so, what is going on, just shows like how important cash is to these shipping companies. That, because like we said before, a lot, the banks have this kind of synergy where they're often providing like trade finance to the shipping companies. So it's all they haven't got these guys cash, or they've got collateral or whatever, and they're kind of happy to offer them credit to take on the derivatives trades.
Or they might even have some kind of like factoring arrangement or supply chain finance or something like that. And I guess the more kind of hooks they can get into
it reduces their overall risk. So they can kind of they can say like there's we've got a lot of credit risk, but actually it's kind of negated in other areas of the bank. But either way, it just shows like that concept of like dead cash and what it's worth to the shipping companies. Would you rather not know how much you're paying, or would you rather deposit money in an account for to receive like a transparent price, trading on the exchange or whatever, and
and we've had some conversations like that, haven't we, where we the people almost kind of know that they're being ripped off, but they almost kind of don't care because it's not like an explicit charge. They're like, okay, well, it's just it's all baked into the hedging cost. And I think Julian's been very clear on this point in the past as well about how important it is to show your hedging costs and your actual purchasing costs, put those on the same balance sheet so you can kind of offset the P&L from both of them. Don't just be like, okay, well, we lost X on our hedge, but we procured this fuel brilliantly at a much lower price. The two things should be netting off, and you've got to kind of look at everything holistically to understand
but it seems like it's easier to swallow when it's just a bit off a spread that you're crossing, because there's no kind of like there's no sort of notion of like money being handed over. Whereas if you itemize costs and things are kind of charged separately, then all of a sudden there's an issue. Even though it is more transparent and you're getting a tighter price, people would almost rather just not know and pay their wider spread.
And I think there's quite a lot of research around this type of thing, isn't there, in terms of like trader psychology. And people would much rather take a kind of percentage chance on a larger possible future loss versus like a kind of guaranteed smaller loss now, even if the odds are against them. It's kind of human nature kind of pushes you towards that, thinking, okay, well, I've crossed a wider spread, but the market might just come back to me, rather than just locking in this kind of cost today, which is, I guess it's illogical, but it kind of plays into human psychology, doesn't it?
But I still think but what we're trying to do, I mean, we've had a lot of feedback from the market, kind of what they find important, and actually it's increasingly obvious that there is a growing demand for transparency, and there is a growing kind of, I don't know.
I mean, it's kind of what we're all about here, right? They're kind of trying to shine a light on all of these things and kind of bring transparency, and we're showing people where our own traders are see value, and in the process we're probably making ourselves quite unpopular in various swings in the market.
But I think but whether you like it or not, that is just the way things go, and that whole kind of opaque market, it just can't last forever. So we've always prided ourselves on being at the kind of forefront of that movement, and even if sometimes it appears that we're a bit early, and it's not always taken up so quickly, but we stick to that kind of transparent like ideology, and being very clear about what we're charging for things, where the bid offer spread is, any other charges. We don't love the idea of baking things into a cost, but we know that that's what some people want, and we're a client first business, so
absolutely.
We're happy to adapt, and credit lines that we offer are tailored to what customers want, but we always try and push this kind of transparent angle where we really want to be upfront with, we can charge a tight spread because we don't need these layers of middlemen, and we are the wholesale market. You know, when you trade with us, you're facing that kind of Onyx liquidity pool, which is, you know, they are the largest liquidity providers of oil swaps in the world, and you're kind of getting direct access to that liquidity pool. So we don't want to start adding layers of bid offer to that to make that not clear. But
yeah, exactly. I think, you know, obviously we're a trading business. We've always kind of felt, you know, we'd much rather make our money from market making, but we kind of appreciate the importance of or the need for credit in certain areas. And where we have offered that in the past, we've always been very clear that, you know, this is how much you're paying to trade. And if you're being extended any credit, then this is how much interest you're being charged on this credit facility.
Yeah.
And those are two separate things. So you can, you know how much you're paying for one thing, how much you're paying for the other thing. Whereas, you know, the kind of bank model, whereas, you know, by the way, you know, that they'll probably be coming to someone like us when they need to flush out that risk anyway.
Yeah.
So you might as well kind of, you know, cut out the middleman by, you know, not going via a third party.
Yeah.
But also, you know, just be super clear that, you know, if you could see that markup that's being added onto that price expressed as an interest rate, it might be quite eye-watering to you, and it might make you kind of think differently if you said, okay, well, this, you know, X dollars a ton is actually like, you know, 20% annualized interest rate. And you see it like that, it actually becomes quite offensive.
Yeah, and we've done the maths, right? And we've kind of worked out that actually, like, it doesn't take to work out like a kind of annualized interest if someone's trading regularly. The kind of extra markup is not that high, which is why we want to, you know, we work so hard to provide tight prices, and then quite often, you know, the question comes back at you. It's like, well, what's in it for you? Like, why are you able to show this? Like, what's in it for you?
Exactly. And it's just, you know, for us, we're a market making business. You know, the more flow, you know, the better it is for us.
Yeah.
And ultimately, we've always been of the opinion, right, that just an efficient market benefits everyone.
But it also shows you that kind of the criticalness of removing as many kind of intermediary layers as possible, right? If there's like $1 spread at the end of the line, but there's 3 intermediaries, all of a sudden you've got a $10 spread. Because everyone needs to eat. So we're about removing as much of that as we can, and that is why we can show that price, because we don't have, you know, 5 mouths to feed on the way down. You know, we are this is the end of the line when it comes to liquidity. Like this is where the banks and the independent hedge providers are all coming to trade. So we just don't need to justify, you know, paying 3 different people to make the trade worth it.
Yeah, no, absolutely. And I think, I guess at the end of the day, you know, whether you want to subscribe to the Flux platform just to view prices for the purposes of benchmarking, or, you know, have a relationship with Flux markets for, you know, direct hedging, you know, it's all about just giving yourself as many tools as possible to make the best informed decisions.
Absolutely. Yeah. And I think like we've kind of noticed that area of the market that was being served, you know, particularly on credit lines, they were really kind of trying to pull the lever of opaqueness as much as possible, right? Because you want to kind of maximize the return. And we found, like, so far in this, you know, relatively new venture for us, we've had pretty good traction with, you know, these credit customers, because they are really benefiting from the transparency in price, the tighter spreads.
I mean, that's kind of always been our sales pitch, right? Because I mean, you can talk about these things sort of academically, and it's kind of harder to get the message across. But we've always been like, okay, well, next time you go to your current provider to get a price, you know, come to us at the same time and we'll show you our price, and then just, you know, compare the two, and then, you know, it should be quite simple in black and white.
Exactly. Yeah.
All right, great. Well, I think that kind of wraps it up really for this episode.
Yeah, it was always going to be a short one.
Yeah, great. Well, hope you can join us again soon, and we should have Julian back with us next week. Thank you very much.
Cool. Nice one.
everyone. Welcome to another episode of Flux Insights. I'm Vincent Wu, Research Associate, and I'm joined by my colleague, Harinder Sandhu, Quantitative Research Associate. And in today's episode, we talk about various topics in relation to the oil markets, specifically OPEC and Venezuela, followed by a positioning review, technical analysis, a deep dive, and a trade idea. So the big news over the weekend was OPEC in their meeting announcing another 137 kb per day increase over the month of December, which follows on from their output increases in October and November. However, notably, their output hike is paused for Q1 next year, citing seasonality and demand concerns, as well as the wider overarching oil glut narrative, in the sense that this will sort of prevent balances from becoming even longer in crudes. And next up, we have Trump hinting at military action in Venezuela. Harinder, you were mentioning that something about this.
Exactly, Vincent. So in recent news, of course, we've seen Trump moving military assets, namely destroyers, vessels, towards Venezuela, potentially hinting at some military intervention there. Is the argument he's going for is the counter narco-terrorism, so really trying to crack down on the narcotics that Maduro, the Venezuelan leader, is well known in the news for kind of being the figurehead of that. So in terms of oil assets and energy, Venezuela has massive oil reserves. So in its oil fields, they have 304 billion barrels, which is larger significantly than Saudi Arabia. So that could be a potential target for Trump to look at in terms of accessing more oil and being able to drive prices down. So that's something that's been recently in the news, but underscore that point that Venezuela has got that level of oil reserves at its fingertips. We're currently looking at about 1 million barrels per day of Venezuelan production, down from around 4 million barrels per day in the early 2000s. So there's still a massive amount that, even in spite of these fields, that is able to come back online, that Trump could be looking at. So that's definitely something to keep an eye on in coming weeks.
Yeah, for sure. Saying that the ultimate result of should the regime change materialize, then, as you mentioned, so much oil reserves in Venezuela, if all the production comes back up online again, recovering to potentially up to 3 to 4 million barrels per day, then that's incredibly bearish for the oil market. Of course, intervention in war, people might have a knee-jerk bullish reaction, of course, but raising production, that's fairly bearish. And Trump administration, even during the first time around, have always been particularly aggressive in terms of rhetoric against the Maduro government.
Absolutely. And I think, US refiners will definitely be thanking him for it. The more sophisticated refineries around that area would definitely be all for higher Venezuelan crude production, which tends to be the heavier sour grades. So yeah, definitely interesting from a US perspective as well.
Certainly. On the price action wise, the Brent has been relatively range bound over the past week, so trading between $64 to $65 per barrel. Seems like the market is very much taking a breather after the previous week's very bullish reaction following the news of the Russian sanctions. However, on the North Sea, we've seen some more bearish sentiment recently. The November versus December 25 DFL, that's the data to frontline. That's in contango as of this week, indicating that there's been some bearish sentiment in the North Sea in the spot crude demand, and there's been some offers, especially in yesterday's window by some trade houses, including Mercuria and Glencore. So that's something to see, because that goes along with the oil glut narrative. But then on the bullish side, last week in our show, we mentioned stronger refinery margins, as well as refineries coming back from maintenance. So it seems to be contention of both bullish and bearish factors. As you see on this chart, the European refinery margins are super high, above $10 per barrel, almost as high as it's been all year. So that's naturally a bullish factor in terms of spot crude demand in the near term, especially for refineries. They'll be looking to capture these margins. And speaking of which, Renda, you you were talking about the EBOB cracks and how that's been very strong.
Exactly right, Vincent. So here we have the Q126 EBOB crack, which again, it's well above seasonal levels for the current time. And it goes to show that the market really is pricing in that undersupply of refinery capacity towards the latter part of the year, early into next year. So even though, yeah, like you said, the front EBOB crack is strong, it seems sort of a little bit more deferred strength is there also. Of course, the Western refineries tend to be quite distillate producing. That's something they're sensitive to, and something we'll come on to later as well in terms of the distillate complex. Gasol cracks, the ice gasol swap crack. It's been particularly interesting in the strength that we've seen, especially relative to historical levels. You know, when we're looking at like the June-July period of time where there was a lot of threats of escalating tension in the Middle East, where the gasol crack was particularly strong. We're seeing levels return there in the absence really of a sort of substantial geopolitical risk premium. So definitely something to keep an eye on. And I think it's what we'll come on to next in terms of the positioning. So first, before we dive into gasol specifically, let's take a look at the CFTC positioning in the last week. So we saw a combination of length being added and short positions being removed, likely off the back of the sanctions that we saw against.
So this is for Brent futures.
That's for Brent futures, correct, Vincent. So that's probably off the back of the sanctions against Lukoil, Rosneft, some short stopping out potentially there. And to underscore that point, we did see open interest drop by about 77 million barrels week on week, which corresponds to about 2.5% drop in open interest, quite substantial, and underscoring that those short positions being removed likely were indeed stop outs. I think in terms of absolute values, we're looking at around 50 million barrels of long positions, about 60 million barrels of short positions removed there. So just to look immediately with Brent futures, you can see the effect of those sanction headlines in the week to the 28th of October. But I think the more timely data, and definitely the more interesting from our perspective that we've been looking at, is the CTA positioning. So this is a chart from our proprietary CTA dashboard available on Flux Live. And we see here, this is much more prompt data with positions, with 1 day forward predictions in positions, the final point on that chart. But as we can see there, there's a really big divergence between gas oil, heating oil, and the other contracts. So gas oil, heating oil, the purple and orange lines at the top, show overextended positioning. Now, what that's suggestive of is that we might expect to see a sort of a reversal back down. And in tests that we've done historically, when positioning tends to reach the extremes like this, there tends to be a mean reverting tendency in positioning, which could see the gasol flat price come down. But I think where the real interest here is that the divergence between gasol and Brent is amongst the widest that we've seen it in a long time. And to underscore that point, I think if we go on to the next chart here, which is the gasol crack. So gasol crack, again, like we mentioned slightly earlier, is at levels we've not seen since the geopolitical risk premium was really incorporated into prices, and we saw real threat of escalation in the June-July period between Israel and Iran and Hamas. So that's what the gasol crack is at these high levels. We see the RSI is, while it's not overbought, it's definitely overextended. Momentum is starting to wane. This could be a signal technically for prices to drop. And to reinforce that, if we look at the CTAs, we see that divergence between the gasol and the Brent. Now, the gasol could come off. The Brent still has some room to the upside. So that could be a further factor that weakens the gasol crack further. So if we take a look at that divergence again in a bit more detail, so zooming really closely into the gasol and the Brent differential with the chart here, we see that, as we said before, gas oil. So with gasol significantly overextended, Brent more at neutral as the blue line shows. As the gasol comes off and if the Brent positioning remains supported, we could really see that gasol crack come down. So from the positioning perspective as well, and you can see it there. That's over the period till the 7th of April. In that June-July timeframe, where the tensions were escalating, the positioning that we see at that sort of middle point in the chart is clearly not so different between gas oil and Brent on an index basis. But here we see a pretty large, maybe a score of about 30 to 40, a difference in the index. So that could be a further factor that contributes to the gas oil crack coming off. So I think there's some very interesting analysis that remains to be seen in the coming days and weeks. We'll be paying attention to the gas oil crack.
Yeah, definitely one to watch here, right? Yeah, very, very interesting. There's such a big divergence, seemingly they, in terms of the relative positioning. So if they were to correct and return to its usual norms, then we could be in for a huge correction in the gas oil crack.
Absolutely.
And on to more on the technicals, we've been looking at Brent futures. So in this chart here, this is showing a wider longer term view since 2022, just showing that overall Brent has been on a persistent, protracted downwards trend with the highs being lower every single time as seen by the blue line, blue resistance line. And even recently, the rally since sanctions 2 weeks ago, that was just a reversion to the mean. And as we've discussed in previous episodes, we've seen resistance at the 50-day moving averages, although more recently it's been sort of sandwiched between that 50-day moving average as resistance and 20-day moving average as support. And there's been much less volatility, although this could always be a precursor to greater volatility in the future with as a catalyst to various different headlines. Perhaps the market's just consolidating and repositioning and preparing itself for the next big move. And on to the deep dive, where we take an in-depth analysis at a particular swaps contract, leveraging Flux Insights proprietary commitment of traders data. And last week we took a look at the Brent Dubai, which saw quite a strong reaction to the Russia sanctions, and price action was quite volatile, as you see in the charts. The M1, the December fell to minus below minus $1 before recovering by $1 towards the end of last week and coming off again this week. So quite a large reaction there. And something I'd like to highlight is that looking at open interest, the market has been quite risk off over the past week, which indicates potentially an aversion to volatility or as a reaction to that. And open interest in the December contract dropped by 10% from 21 to 29 oct. However, overall levels do remain quite high, much 40% above the 5-year average. That's what we've been seeing in the contracts in Brent Dubai over the past 2 years. That's nothing new. But the decline in OI is certainly an interesting point. Carrying on through to the next part, where we see that looking at positioning, specifically the counterparty types, trade houses use this as an opportunity to close their short positions. So even though with the news, logically it's meant to point towards a bearish pricing, bearish price action, bearish price trend, trade houses, perhaps they were already positioned short, so they used this as an opportunity to take profit and close their positions, which we could also see in the declining open interest. So all of this meant that, prices were going to go down, but this is a chance to de-risk, as we see in this chart. Trade houses almost completely unwinding their positions against Onyx traders.
Absolutely. Yeah, I think you've summarized it brilliantly there, Vincent. One thing I would add as well, from looking at the news and wider market context during this time period, it's been very uncertain as to whether indeed a lot of the refiners, the Indian refiners, are in fact switching away from Russian barrels towards the Dubai grades, which of course would be supportive for Dubai and lead to that bearish Brent Dubai thesis coming true. So there's always like a little bit of uncertainty as to whether, you know, those Russian barrels are still finding their way into the Indian refinery, which is the main Indian, potentially Chinese refinery complexes. So that's probably, that could be one of the reasons why there's shorts uncertain in these market conditions, just take their risk off, and we saw that the corresponding decrease in open interest. But you were saying with the shorts as well, as you mentioned, that they've removed their positions and they happen to be in the money, which is good for them for sure.
Yeah, very, very much. It seems like the shorts entered around the minus 15 to 20 cent dollars. Minus 15 to 20 cents per barrel level. So they were very well in the money as a result of the bearish prices. So taking profit, and they're still overall in the money as well. So gives them a chance to redeploy positions if prices keep going up again. So good optionality there. But also, of course, with the as you mentioned, whether Indian refiners continue to buy Russian crude, all of that, the sanctions stuff, it lends well to our crystal ball moments. This is where we look at the market fundamentals, look at the market chatter, and talk about whether we think things are bullish or bearish for crude prices. So yeah, Harinder, what are your thoughts on considering all of these?
Absolutely, yeah. So I think the first factor, which kind of has branched into two lately, with the Venezuelan situation as to whether Trump does indeed push for that regime change, try to get Maduro out, killing two birds with one stone with the narcotics, but also potentially gaining access to the oil fields, would be a much longer term operation. And of course, we wouldn't see an immediate bearish move in prices, or likely we wouldn't see an immediate supply increase. It would likely be over the long term. But there was also recently the headline with regards to Nigeria, which we didn't mention during the herd mentality, but is also quite important, with some sort of conflict going on there that seemed to leave Trump quite disenfranchised. And of course, Nigeria is a very important producer of various crude grades, but I believe more on the lighter sweet front.
Lighter sweet front, but of course, 1.5 million barrels per day. Of course, key market, or West African crude also prices up against Dated Brent.
Absolutely. So you can see there's a little bit of of course, there's two conflicts which could lead to a very different change in production. And of course, as you mentioned, the sanctions earlier, as to whether indeed the Russian barrels are finding a home, or if, as we've heard, there's been a number of headlines out lately that Lukoil and Rosneft, those two major state-owned companies, have been suffering, but whether those barrels are perhaps still finding a way into some refinery complexes. So yeah, there's a number of factors at play there that could both support and be pressuring prices downwards. But I think on the grand scheme of things, I would be slightly bullish here, at least for the short term.
That's very interesting. You mentioned that's all things are turning bullish. Of course, on my side, I'm fairly bearish at the current levels, just because from technicals are pointing towards a gradual build up in bearish momentum, especially in the long run. And I personally think that the market thinks that the Russian flows will be adjusted in the medium term. Of course, Rosneft and Lukoil, they can divert the crude oil elsewhere, as well as the fact that after the diversions, there'll be intermediaries facilitating this flow. And in terms of sanctions enforcement, of course, the EU price cap, oil price cap, is still very much in play. So overall, Russian oil isn't being completely shut down, but it's just making it harder for intermediaries to work around it. But as the market has readjusted over past rounds of sanctions, especially since what has happened in January, people are of the thought that this will continue to happen. So, and as we've seen with Brent sort of coming off after the initial rally, which suggests to me that the market isn't as worried about the supply tightness issues, especially as OPEC continues to ramp up production. And there was this thing that mentioned perhaps the Q1 pause and output hikes might be an olive branch to Russia, which has been, of course, facing a lot of issues with the sanction and as well as the Ukrainian drone strikes to its energy infrastructure. So these are all things to watch, as well as potential staging grounds for military conflicts, or at least rhetoric becoming more and more aggressive. So fairly bearish. And finally, we have our Flux Alpha Trade Idea, where we shine a light on our weekly trade ideas report, where we have discussed various trade ideas relating to the oil swaps market, and of course, which can be accessed through a subscription on Flux Live. This week, we have discussed the short Q1 naphtha East-West. That's the differential between the Asian benchmark, MOPJ, and the European European benchmark, the NWE. So we're going, the idea is to go short here. On the chart, you can, we've highlighted the blue line as the entry, the red line is the stop level, and green line is our price target, so leading to a 2-to-1 risk reward to risk ratio. And the justification is this: previously the East-West has rallied substantially on the back of the geopolitical risks surrounding Russian sanctions, especially, which is more relevant to Asian naphtha, as well as freight rallying because of as a result of this geopolitical risk as well. However, recently we've been seeing a lot more selling interest towards in the East-West, which has almost overpowered the bullish flows in MOPJ, as well as thinking that the market may be better priced in the effects of the sanctions towards Russian flows. And if workarounds are found, then potentially in the NAFTA market, then there will be a more of a bearish reaction, especially as there's been a lot of buy-side tenders from Eastern players in the physical window in MOPJ. And once that subsides, we could see a lot more pressure in the East, whereas in the West, NAFTA demand is expected to continue, especially because of, as you mentioned earlier, a lot of gasoline supply tightness issues, as well as Dangote is still having not at full capacity, so this will attract more blending demands for European naphtha, especially to make their way into its gasoline blending pool to be exported. Absolutely. So all things considered, we're fairly bullish in the Q1 naphtha East-West.
Yeah, I think you've summarized it again brilliantly there, Vincent. Just as we mentioned before with that EBOB, the Q1 EBOB crack at those levels, of course, it doesn't incentivize players to be looking to naphtha, the Western naphtha EBOB, the NWE naphtha contract to blend into that gasoline pool and profit from those high EBOB levels. Just a little bit maybe on the interest of the tradecraft here, and perhaps the technicals that could contribute further to the prices coming off. So as you've set the stop to be just above that level of resistance that we've seen, which makes complete sense. Of course, if it broke above there, that would invalidate the thesis a little bit. And the take profit is again at the level where we see some support for the East-West prices. So super interesting. I think again, from a technical perspective, if we were to zoom in a little bit on the candlesticks, I'm sure our argument would be justified. We've seen twice resistance, sort of lower highs and I'm sure lower lows to come. So this will be a super interesting one. And as you rightly mentioned, from our COT data, it's one I've been paying attention to closely, systematically as well. It's been one of our alerts, the December East-West and the January East-West, and indeed MOPJ cracks as well. So these have been the contracts, and after complex has been super interesting from a systematic positioning perspective, in that we've seen a lot of the shorts, they've deployed a lot of their risk. The open interest is well above the 5-year max levels, and they've been adding to that short position, indicating conviction in that short trade. So again, super interesting contract and one to watch in the coming week.
Yeah, it's super interesting. Yeah, especially with the positioning stuff and the technicals. The double top we're seeing losing the bullish momentum. So yeah, there's great risk reward and going short here.
Perfect.
Great. That's all for this episode. Thank you very much for tuning into Flux Insights. And for more insightful shows like this, please remember to check out flux.live.
Hello, welcome. This is the first and only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar, it's all here in the next 30 minutes. So, this week, the man who would be in charge of energy in the UK if the Reform Party, ahead in the polls right now, actually formed the next government. Richard Tice tells us what's gone wrong with energy policy to date.
We were a rich nation when we had cheap energy. We're now getting poorer per person by the week, the month, the year. And the primary reason for that is we've got the highest electricity prices in the developed world.
The 40s oil field at 50. Happy birthday to an area of the seabed that's been worth $500 billion at today's prices to the UK economy over the last 5 decades. And we look ahead to COP30. The Brazilian hosts are hoping to make progress on a number of fronts at the next climate conference, and the UK has deemed it important enough to send the Prime Minister to South America. Joining me to discuss the week's events, Greg Newman is here, Chief Executive Officer of the Onyx Capital Group. Let's have a listen to the interview, if we can, and some extracts from it. My interview with Richard Tice MP, who is, of course, the MP in Lincolnshire. He's the Deputy Leader of Reform. His constituency is Boston and Skegness. Now, there are only 5 Reform MPs in the House of Commons just now, so he shadows the energy brief. We spoke a few days ago about some of the big questions around energy policy and how his ideas are nearly always very different to those being enacted by the Labour government.
I've met oil and gas companies in Aberdeen and in London, and Nigel Farage and myself have said to them very, very clearly, a Reform government will grant you all the licences and exploration permits that you want, obviously subject to the usual regulations regarding safety, but we've said to them, get your applications ready. A Reform government is coming, and get them ready in the year before. I've even said, in order to try and accelerate the process, we might look at having some form of shadow regulator that can, in draft, look at and approve any such licence applications in the run-up to a general election, so that if we win a general election, then those applications, we know that they are basically pretty much oven ready, good to go. And the people we spoke to are delighted by that pro-growth, pro-energy agenda. We're very clear, you cannot be a rich nation unless you have cheap energy.
Well, you couldn't get clearer than that, Greg, could you? He wants to drill and keep drilling, indefinitely, perhaps.
Yeah, it's a big, complete 180 to the Labour government and even the Conservative government before that. And it's like we were talking about last week. I mean, there are a lot of benefits that are immediately obvious from the commercial point of view. But I guess he goes quite a bit further than that, because it's introducing fracking as well. So I think one of the main arguments that people have been pushing that on the antithesis of doing more drilling in the North Sea is we're running out of production. And you could dispute that, and people are disputing that. Like Wood Mackenzie came out with a big report being like the 9 or so billion barrels that could be there or are proven to be there. It could be as much as 25 or 30 billion barrels if you really apply some of the techniques in drilling that are up and coming. And we've always been in a state in the world of improving drilling to get more production. And fracking is a version of that, right? That's what the US did. They started fracking, they got this new technology, and oil was meant to be running out, and all of a sudden they're the biggest oil producers in the world. So him introducing that does signal that no, not only do they want to, suck as much as they can out of the existing set of ecosystems that we have, it's no, let's go even bigger than that, and let's now introduce fracking, and let's be a leader in this space again, which excites me personally. But yeah.
Okay, well, let's hear from himself on that very point, shall we? Here's Richard Tice then explaining why he is a big fan of the fracking idea.
Well, let's be clear. We're talking about shale gas, which is the energy treasure under our feet. There's a decade plus worth in Lincolnshire alone. And fracking is just one technique of extracting shale gas. There are other techniques. The technology evolves all the time. But why is it that America's got gas prices a third of ours? The answer? Shale gas. The answer? Because they frack, they extract it. There's about 20 million people that live within a mile of a shale gas well. They barely know they're there. They're tiny. They're safe. And that's the reason why the American economy is growing fast. It's powering ahead. They get richer. We get poorer. It's a catastrophe. We should be using all our energy treasure. We should be using the technology as it evolves. And it's a great opportunity. We should go for it. I tell you what, when I talk to people in Lincolnshire, they're very proud of the idea. Lincolnshire gas for Lincolnshire jobs and Lincolnshire growth.
Well, that couldn't be clearer. Again, Greg, how mature is the whole shale gas industry, though? When you're placing a bet on whether it's going to work or not, whether you want to invest money in it or not, how certain can you be?
Well, this is the thing. So there was a big commitment in the US to fracking and drilling, horizontal drilling and all these techniques. They kind of had open rein to explore it. I think that's when we talk about the political side of things and how investable as a country. And despite, whoever you want to talk about who's been presidents before, pro-oil Trump, you have as an oil driller, oil producer, an independent wildcatter, as they call it, you've had largely free rein to explore underneath your land. It's very different in the UK, right? You have like the royalty, the king owning a lot of the land, and it's very different. And, you're talking about drilling underneath potential land rather than just offshore. It's a very, very different concept. It would be a dramatic change. But I guess what's interesting for me was I kind of written it off in my head as well. I've heard about fracking being discussed. It causes earthquakes, and that's what you've
There's
heard.
all those alarm things around it.
Well, but it was a big deal. 2019, it got banned, properly banned. And since, I don't think people have really talked about it. So to bring it up again makes me think that he really has spoken with the industry a lot. And then actually, let's not forget, earlier on in the year, Egdon Resources were making huge claims about in Lincolnshire, which is obviously where it's important to him, has an enormous potential field for fracking gas. And the claims there were like, 100 to 140 billion in GDP, 250,000 jobs, that kind of stuff, which obviously is aspirational. But I think when you read that and you see that, and it's not viable, it's not yet, you couldn't classify it as proven from what I understand and what I'm reading. But at the same time, there's obviously enough excitement from Richard Tice to be like, God, that is so not what the Labour government would do right now. If I was to come in, you could go from basically failing, fledgling industry to bang, huge economic growth and tax receipts.
With the timeline involved, though, they're not in power yet. It's 4 years, 3.5 years possibly out if they get the gig. And then there will be a beginning time, and renewables are coming on stream. So let's hear a little bit more about that. Richard Tice was pretty dismissive about solar in general, and certainly not in the fields of Lincolnshire. By all means, put a panel on your roof then.
Look, climate change is real, has been for millions of years, always will be for millions of years. The arrogance amongst the eco-zealots who think that they can stop the power of the sun and stop the power of volcanoes, that are the two primary determinants of climate change, is truly shocking. And I can tell you my constituents are raging furious at the cost of their bills, that the idea that 100 square miles of Lincolnshire should be covered with solar panels completely surrounding whole villages, the idea that hundreds of pylons should blight my constituency is nothing short of a scandalous outrage. I've told National Grid, bury the cables or we will force you to bury them at your shareholders' expense. So people need to know we are deadly serious about this. Net zero is the wrong thing at the wrong price in the wrong time frame, and we're going to stop it. We are rapidly changing the course of the debate and encouraging investors and shareholders, invest in oil, invest in gas. That's the future.
So, some limited interest in the solar market. I found the whole thing about Chinese panels. Everyone in the world's putting up Chinese panels, isn't it? He's averse to that. Which would mean, I suppose, his interest in solar is even limited further, probably limited by the amount of Canadian panels he can get hold of.
Yeah, that was interesting. And this is obviously not really my expertise, but anecdotally, it's interesting to consider how aggressive he was being on the geopolitical element, which, really, when we talk about private investment in renewables, and a lot of it is foreign, right? Foreign investment. And he's highlighting that. So, they do benefit. And at the same time, when we have CFD mechanisms that he also talked about, guaranteeing the price to foreign firms, you don't really get that back in your economy as much as you would if it was domestic. So I understand his kind of general point, obviously, but in terms of land, farmland versus roofs and all that, I mean, okay, fine. I mean, it sounds logical.
Yeah, that's coming, isn't it? I mean, the French, I think, are putting, if you've got a car park above a certain size, you have to put the panels over the car park. That's a good use of land, right?
It is. I mean, again, I was ashamed Julian's not here, and we will obviously talk about this next week and beyond. But what you're actually getting from solar, and especially 28 million odd homes in the UK, how effective is it really going to be? I think the answer would be, in combination with other renewables. But it doesn't sound like he was against it at all, like you were saying, like you're saying. But it is about the Chinese element, and with all the Chinese spy stuff going and all that. Clearly, it's a bit of a dig as well, right?
Of course.
What's going on. So,
and again, the world may have changed. Greg, there's some other headlines we need to talk about this week, because I note that the ExxonMobil chief exec, Darren Woods, has told Reuters the US energy firm may stop doing business in the European Union unless the bloc changes a sustainability law. Now, what's he on about? Why is he particularly concerned about what the EU are doing?
So it's the new law that's coming in 2026. So it's been, from my understanding, more of like a transitionary thing at the moment, but it's coming in hard in 2026. So a carbon border adjustment mechanism, CBAM. It's just, to be honest, the way I'm seeing it, it's just a tax on anything you're importing that's considered fossil fuels. So it's just coming at a really bad time, isn't it? Like, we've got energy prices already high. And then, I mean, if you're smart, I guess from a government perspective, you'll try and avoid the link to energy prices, but it will impact energy prices, or it'll just impact everything. And it's quite inflationary. And I mean, that's why I know you mentioned the introduction, COP30 coming up. It's just such an important time, because you're really losing the kind of faith in the net zero project, largely speaking, around the world. UK is still hanging on to that leadership concept, and obviously Ed Miliband is banging that drum. So when he's faced with these things, and faced with big countries coming out and saying, we're not going to trade with you if you do that, you're up at so many headwinds now. Before you were trying to lead, now you're going against everyone. And by the way, your public are not enjoying the high energy prices. It's making it very awkward indeed. But that's what I think is so interesting about this timing, and obviously Richard's all over that, right?
Yeah, he would have the public on his side as well. Look, we've got a significant birthday we need to mark. Take a look at this.
The 40s field was the very great one, but it was a remarkable pioneering spirit, and many people will claim that their field started it, but the 40s field started the North Sea in earnest.
If we hadn't taken advantage of the North Sea opportunity, we should have been shot. It was a project of a scale that, I don't think Scotland's ever seen before. Not just size, but the sheer groundbreaking technology involved. Frankly, it was science fiction type engineering developments.
It's an incredible story. BP was able to do tremendous things when they developed the field in the 70s, somewhat similar to putting a man on the moon, because they were going into uncharted territory. A development of this type had never existed in the North Sea.
This was seen in many ways as being quite a big game changer. After the time when we had been on the back foot, we'd been on the receiving end of the price increases pushed through by Saudi Arabia and the others, and suddenly here we were going to have a chance to be in the driving seat, and it was indeed the start of a golden age.
Well, that was a clip from a company video from Apache. They now own the Forties field off the coast of Scotland. It was a video made 10 years ago, actually, to mark the 40th anniversary. There was an expectation that exploration may well have stopped by now, but in actual fact, it's still going, isn't it? And still going well.
Another example of, proven reserves is very, there's a barrier to that statement, right? But actually, when it's unproven and there's all these technological advances and geology is uncertain, you don't know if you keep going, and private companies are still willing to invest. But from the birthday perspective, I mean, there's two things. One, immediately, it's quite interesting to me because I've got a little thing on my office that basically a bubble of 40s oil. It was the first time that they, from BP days, when they owned the field, when they dug it up, they gave all their employees, and one of them was my best friend's dad, and he gave it to me for a wedding present. But anyway,
right.
The point is that 40s field, again, for the average person, it's like, who cares, right? But it's incredibly important. And why? because Forties is in the North Sea fields that are used to set the price for Brent, which in turn is used to set the price for as much as 80% of the world's oil. That's hugely significant, right? It's a price setter. And then Forties is one of those grades, one of 5 or 6 grades now, and that is the cheapest, generally speaking. So because it's the cheapest, it tends to set the price. That's how the methodology works. So more often than not, it's kind of changed recently because of the US oil now being involved in the benchmark. But I don't want to get too technical. The point is that Forties field for the longest time has been setting the world's oil. The whole world's oil price, 80% of it at least.
That relatively small area of the North Sea has been driving the whole thing.
Incredibly important. And the Forties pipeline, which, famously for the industry at least, was connected to Grangemouth refinery. It goes pipeline straight into the UK. That mechanism is just so unbelievably important, as I say, because it's this oil that sets the price. So when anything went wrong, it was hugely significant and still is to some extent. There was a hairline fracture in 2019 and it's paused production for a few days, and Brent skyrocketed, the Brent time spread skyrocketed. It was carnage. I was in
consequences of one little crack.
And it wasn't even down, it was temporarily down. And then the price setter agency, the index setter Platts, they had to make adjustments and they had to say, force majeure. And there was a big calamity because it's amazing, right? This tiny oil field, relatively speaking, to the rest of the world has been so important to the world. Would you know that? So I don't know.
No,
it still is.
I wouldn't. And we have to acknowledge, I think, back 50 years ago, the engineering skills that went into actually creating that oil field, it wasn't straight question of moving stuff in from the rest of the world. They really had to think it through.
100%. But this is what we're talking about. BP in particular were incredibly innovative company. Obviously still are, but they were world leaders. And this is what I was talking about last week when we can't give up, I believe, all this expertise that we've got. This was 50 years ago and it sets the world's oil. Why are we just saying, who cares about that? It's incredibly important. And so
it's an asset worth preserving. Okay. We mentioned COP. Let's do it now with start of COP30 in Brazil coming up over the next 10 days or so. The latest global emissions report has been published by the UN. An introduction from the Secretary General, Antonio Guterres.
Renewables are leading that transformation and rewriting the rules of energy. Costs are falling, investments are rising, innovation is surging. Clean power is now the cheapest source of electricity in most markets and the fastest to deploy. It strengthens energy security, cuts pollution, and creates millions of decent jobs. Leaders must seize this moment and waste no time in tripling renewables and doubling energy efficiency by 2030, building modern grids and large-scale storage, and ending all new coal, oil and gas expansion in a just and equitable manner. The clean energy revolution must reach everyone, everywhere. But developing countries face crippling capital costs and a fraction of global investment. They also need far greater support to adapt to worsening climate impacts, protecting lives and building resilience. We need a quantum leap in climate finance to lower the cost of capital and expand concessional lending.
Greg, interesting to notice he talks about the financing of renewables, the familiar refrain coming from the UN Secretary General here about climate change and everything else, and let's do more about it, celebrating the progress made on renewables. But actually the finance industry of the renewable side of energy are going to have to wake up to his call or not. I mean, that will be how this thing works, isn't it?
Yeah, I mean, going back to 2021, which I would say is the peak of net zero talk and investment and the greenifying of everything, greenwashing. You had trade houses, in oil, that everything was about, we're a positive renewable company. You're an oil company, but you're just glossing. The joke was, beyond petroleum that with BP, how they had Bernard Looney really banging the drum. That all peaked in 2021. It was very easy to get financing. If you put green on anything, it was a bit like AI now. You would get investment. And I think there was a worry for some time. People thought a lot of those companies, it's a huge bubble, it's going to burst. Funnily enough, what's recently been talked about, at least in the FT I was reading, or Bloomberg rather, that despite particularly the Trump side of things, the green equity markets, the equity markets exclusively for the green technologies are doing very well. And I guess from a financing perspective, that's ultimately all you're going to care about. Is there a return? Are we seeing a performance? And I would say the work has been done, in my opinion. And yes, it was a bubble, and yes, it was a bit crazy the way people were just washing everything. But now it looks kind of more and more viable, right? So I think I kind of understand the call to arms for financing, but if it's economical, it's economical, and that's markets, right?
The market will follow, isn't it? If there's a profit to be made.
Yeah, but solar, that kind of thing, the cost 95% down in the last 20 years.
Yeah,
in
it is
cost.
extraordinary,
So I can't see why. And Elon Musk was also talking recently, like he takes a much more pragmatic point of view. In 50 years' time, it's probably going to be a bit of a job to unwind if we have trillions of carbon emissions in the world to change chemical composition of the world. But let's not be so alarmist. We've got time. We just need to lean into this transition. So I think people are on board with that concept. We're not going to unwind anything. So when Richard Tice says, just forget it all, I don't think that's going to happen.
Quite the right approach.
And I think there's money in it, to be clear. And that's what he's getting at.
Well, the Prime Minister's over there, I think, over this week in the sort of pre-build-up, and I'm sure on next week's programme we'll be alluding to COP30 because it'll be underway and things have already been said. Just as we came into the studio, actually, Greg, we've got some word here, a small matter, but you may have some money owed to you on your electricity bill. Ofgem, the regulator here in the UK, so you should check your accounts, check if you've moved house.
I mean, I had the opposite. They were demanding money from me the other day. But I understand, like, the things of the price cap. It got quite complicated, didn't it? And I think, you forget that the difference between electricity in particular and gas than oil, gasoline, diesel, it's so much more, your bills are so much more volatile. And there's all these changes and subsidies going. You do need to keep on top of it because it can benefit you.
You moved house in the middle of a quarter or something, you might have 200 quid invested on the old house's gas bill. That's what we're saying. Anyway, it's worth double checking with your supplier, whoever that is. Right, we've got the latest data. Let's just walk through these. The forward curve, this is on diesel prices, I think, isn't it?
Yes. So again, what do we mean by forward curve? So we just turn to NOV, of course, where we are now. And you look at the green. So we're £1.46 roughly, or £1.45, 50-ish. That's where we are right now. What the forward curve means is the market's already pricing in the future, right? So right now, this is what we call backwardation. Let's not go into it right now. But the point is that because of views on storage economics and things like that, the market is trading the future months at more of a discount than what we are right now. So basically, if you're trying to hedge, if you can, and we'll be talking about that in a bit. But generally speaking, if things stay the way they are, you should see a reduction in your pump price. Unfortunately, this is what we mean by markets being so dynamic, right? That they're not efficient despite what people tell you. That might be pricing in by February, that prices will be down to £1.42 on diesel. But I can tell you right now that the calls from the oil market, you have the CEO of Totsa, I think the trade houses, Vitol, Mercuria, they're all saying, guys, you really need to watch out because this latest Trump sanctions is not being factored into the market enough in their view.
And I think that could be a disruptor.
A huge disruptor to the price, and we haven't really seen anything yet. And I think in particular on diesel, that's the impact on Russia in particular. It could be a hell of a lot higher than right now. So if you could hedge, and we'll talk about this in a bit, it's a good time to do it. But yeah.
This is the UK Energy Show, brought to you by Flux, the biggest news, information and trading platform for world energy markets from Onyx Capital Group. Now, next up, what's the buzz? We've had quite a lot of feedback to the items we've been posting on social media channels, so we need to check on what's being said. Greg was with me once again. Here's a post, for instance, underneath the YouTube interview with Richard Tice we posted. Here's just one remark, which was common of many. It's not cheap just because it's in our territory. I imagine he's talking to UK Energy. We've sold the rights to foreign companies who then sell it at market prices. You know what forms of energy are cheap and homegrown? Renewables. Well, we know where that guy or girl is coming from.
Cheap and homegrown in terms of, I guess, the input being wind and that kind of thing. But I think if you look into it, right, renewable infrastructure is very invested by foreign companies as well. So,
yes.
And even when you look at the oil and gas, I don't know about that. I mean, there's a lot more legacy companies that are more, certainly BP still owns assets, for example. But yeah, I mean, I would actually go back to if we were to reinvest into our refinery complex, we've only got 4 now, and build that back up to, I don't know, 10 plus, that's been more in more recent times. That's a lot of investment that we should be encouraging. That could be domestic. So I get the point, though. It's just a bit of a whatever point.
Well, it's a comment. It's a free country. We get quite a few Reddit followers. So thank you very much indeed for doing that to us. Here's one. We've got 10 years supply of our own proven reserves. Norway's got 15. Time to start drilling for new wells.
Yeah, I mean, again, this is the argument that's always said. But again, we are talking about, the numbers, 3.3 billion, definitely we know, 9 potentially billion barrels, but as much as 30 according to other sources, because we don't know. We've got to apply these technological advancements. And we just talked about fracking, right? Fracking could really increase that. But more importantly than that, people don't know. And then you see online, you see politicians say, the experts say that. But if something's an estimate, it's a bit like asking a company for an estimate on anything. Like, what's their agenda behind it? Like, why would they necessarily know themselves unless something's like completely verifiable? They don't want to get caught out themselves. Anyone who's predicting wants to be kind of conservative or just wants to go along with whatever you say. We've got consultants in our game, in the oil market, who just say whatever OPEC want to say. I mean, quite literally, we talk about it all the time.
Yeah, I could do that.
Yeah, that's what I'm saying. They just say the oil market price is going to go up. Of course they're going to say that because everyone benefits. So I think that it's that, A, and B, let the market do the talking. There are still companies that are willing to take the risk on UK assets, which I find surprising because it's completely against it. They obviously think, I don't think it's being tapped up with some of the newer technology. But then worse than that is Norway's state companies want to invest in our assets. So doesn't that say everything for me? So I mean, I don't know, that's very frustrating. And I would just straight up disagree. I think maybe he'll say
there's plenty of that going on Reddit as well.
No, I know, but what people love to do is say, but it's proven, the experts, what do I care when an oil trader thinks? I've seen this, I've seen this report. It's like, what, you've never seen an official report be bollocks? Like, you know what I mean? So anyway, I get it, but I would really implore people to kind of like just look around it, right, and see the other points, see what other people are saying, see what private companies are doing.
Well, this is the part of the fun of responding to some of the Reddit comments. Quite a long essay here. I won't read it all to you. Your gas bills went up. That's got nothing to do with net zero, says this poster, who I think is somebody called Steve, responding to somebody else. As the UK needs less gas to produce electricity, there's less demand, and so the price goes down. Wind and solar to produce electricity actually saved the UK 100 billion in cheaper gas and electric since 2010, and so it goes on. It's a lively debate, and it's interesting to follow the threads there, isn't it, of people, the to and fro of all this.
It is, but again, you're just taking, so someone came out and made that statement. It's very hard to verify, because what you're saying is the gas prices were where they were, and the electricity is set by the marginal price of gas. So if we just set the price based on wind and solar, we would have had cheaper electricity, but it's not about that. It's about the grid infrastructure. It's just more, you can't set everything on the wind and solar because it doesn't supply enough. We need to use gas. So yes, if we change the CFD mechanism, but Julian and I were talking about that a week or so ago, and it would probably reduce your bill by about £100. So it's not as cut and dry as that, but I understand obviously the sentiment.
It's an adjustment rather than a slam dunk. Okay, well, here's another one just to finish off with, quite a light-hearted remark, I think. Again, responding to Richard Tice, what is a foreign renewable? I guess that's what he said during the interview. Are the Dutch hoarding all the wind?
I think it might have actually been the way we worded it on our
maybe
thing as
we
well,
did.
but
Clearly not. Clearly not. But it's interesting. I mean, the Dutch aren't hoarding the wind. Wind, we should just say in passing, I think the stats for October came out from the electricity generating people, the NESO people, and it was over half, 60% or something, in the month of October of our electricity was generated by wind. So that's where we are.
Yeah, I mean, what I would say is, that is one of the benefits of being an island, of course, because Germany, the market's still very worried about the lack of wind. It caused a lot of problems.
We use it all.
And exactly, we hoard it.
They get none of it. And so it goes on. All right. Well, before we go for this week's edition, let's just look ahead, if we may, Greg, to next week. The COP30 main event, of course, starts on Monday. So by the time we do another one of these programs, it'll be well underway. You got any ideas of what decisions may or may not be taken?
Well, I think there's one thing is the COP itself and the things that come out there. But I think obviously for the UK audience, it's about what has been said around it. And I think just one thing to know from me, just because we talked about Richard Tice and his interview, I think more and more what I'm seeing is when people talk about domestic oil and gas production and fracking, etc., there is this argument increasingly coming in, which is, look, if people are starting to accept that we're going to need oil and gas for at least 10, 20, 30 years, whatever it is, even if we do a hardcore transition, then isn't it better to have it domestic so you have less carbon emissions? And even with the one in Lincolnshire, the fracking project in Lincolnshire, the potential project, that's 200 billion emissions they were talking about avoiding by having it domestic. So I think that argument, expect that argument to be made more and more. And I personally think it's quite compelling because if we're going to use it anyway. So COP30 is all about, we do need this stuff. The energy centers from the AI boom, that's kind of taken charge, and expect that to be talked about a lot as well. It's going to be very hard for Ed Miliband to do the whole, but we need to keep going, and we're the leaders because people are pretty bored of the UK's point of view now, would be my point of view. So,
well, before we go, we've also should mention the fact that one of the aims you've got here is to try and bring this whole, the mystery, to demystify, if you like, particularly the energy market and the oil market and so on and so forth. And in the coming weeks, there will be a way that people can democratize that to a handheld device.
So this is obviously, I'm super excited about it. If you know anything about the business, which most people probably don't, the wider audience, but if you check us out, flux.live or onyxcapitalgroup.com, or check me out on LinkedIn, the books are written, or the book I've written, the content we put out there, everything is about our position in the market is providing prices. And why shouldn't we provide prices if we're doing it for all the trade houses, the majors, the big oil companies, why can't we do that for everyone? The big challenge to that is people are like, I either don't get it or I don't even know how to think about what you're talking about. What even is hedging, this kind of thing. So what I'm really on a mission on to do personally with the business and all the guys here is let's create tools and intuitive tools so people can understand how to use this market that we trade to benefit themselves. And essentially boils down to the first big step there is try and use this market to protect yourselves against price increases, which, look, as I said, with Russia and the sanction situation is a really big deal. So we're going to be talking about what that solution is, and it's an app, and we'll get into it. But just to note, super excited. And yes, it is about demystifying, but it's also providing solutions, right? Anyone can moan and get on a podcast and talk shit about everything, which is what a lot of people do. We want to provide solutions as well. So yeah, that's it.
Thank you. Look out for that. It'll be available on all the usual places.
Hello, welcome to the Officials North Sea window update. We had a very offered window today, so let's get straight into looking at the bids and offers that we had in the North Sea. So today we had a big step back by the buy side. So both Exxon and Phillips removed their bids that they had put in yesterday, and we had an increased pressure from the sell side. So particularly if we look at Midland and Forties, this Mercuria offer that we got today for 26th November to the 1st of December offered at 125. Yesterday, we had the same cargo offered 40 cents higher at 165. So the Midland curve is clearly a lot more depressed. Likewise, Forties, we had BP offering the same 1st to 3rd of December cargo as they did yesterday, but again, 40 cents lower. We also had ENI step in on the sell side, offering both Forties and Ecofisk. ConocoPhillips was still there as well, offering Ecofisk again. So clearly, Midland and Forties both much, much weaker today than yesterday, and that should see us with a much weaker diff as well. What we'd seen yesterday was already a bit of a turnover from the recovery we'd seen from the negatives in a couple of weeks ago. So we fell from 58 cents to around 44.5 cents yesterday. The expectation is today will be much weaker again, maybe down to around 10 cents. So it's really a story of weakness in the North Sea. And it's not only there in the physical that we got weakness, but also in the futures. So yesterday we saw a sell-off in the morning in Brent futures, bit of a recovery in the afternoon. And here, what you've got is a massive red candle in the afternoon into the window today. So this really is a massive sell-off in the Brent futures. And the same is true for the prompt spread. Yesterday, we saw that while the futures rebounded, the prompt spread failed to really recover alongside it. And the story today for that, again, is another day of weakness. And even now, we're getting below 30 cents for the first time in a long time. Remember, we were at 60 cents just last week. So this is a big sell-off in the structure, a big weakening on flat price, big weakening on the physical. Everything's getting softer. And we also today had big news from ADNOC from the UAE, who released their OSPs for December, and Murban was much lower as expected, but also Upper Zakum, the differential was much, much weaker than it was last month. So there is really a feeling of weakness in the market today. The next big thing will, of course, be the Saudi Aramco OSPs, which we're expecting to come out soon in the next couple of days. So make sure you stay tuned to hear about those.